Please like, share, and subscribe. Wishing you happiness and good luck every day.
The stock market. You hear about it all the time, right? It can feel like this huge, complicated universe that's just not for regular people. But what if I told you that you don't need a PhD in finance to get it? Seriously, in the next few minutes, we're going to break it all down so you have a solid handle on the basics. All right, let's jump in.
So let's start with this bombshell of a quote from our source material, Michael Sincere's book, Understanding Stocks. He's talking about the pros on Wall Street. Kind of jarring, right? It pretty much confirms that feeling a lot of us have, that the market is this brutal game, and if you don't know the rules, you're just going to get steamrolled.
But hey, that's exactly why we're here. We're going to give you the rule book. Here's the game plan. We'll start by welcoming you to the game. Then we'll figure out what a stock actually is. After that, we'll look at the two big ways people pick them, dive into the psychology that drives the whole thing, and most importantly, learn how to sidestep those classic rookie mistakes. And we'll wrap up with what your next move should be.
All right, first up, welcome to the Wall Street game. You know, before you play any game, you got to understand the playing field. This right here, this is the key. Forget all the crazy charts and the confusing jargon for a second. At its heart, the stock market is just a massive worldwide auction. You've got companies on one side who need cash to build new factories or invent the next big thing, and on the other side, you have people like us, investors, who are willing to give them that cash in exchange for a piece of the company. That's it. The market is just the place where they meet up.
So, in this giant auction, what is everyone buying and selling? Well, that brings us to the most basic piece of the puzzle, the stock itself. So let's get crystal clear on what that actually means.
A share of stock is, well, it's exactly what it sounds like. It's a literal share, a tiny slice of ownership in a company. So when you buy a share of, say, Tesla or Amazon, you're not just buying a symbol that zips across a screen. No way. You are actually buying a small piece of the business itself. You become a part owner, a shareholder.
And this is how that whole process plays out, broken down into 4 simple steps. First, a company decides it needs cash to grow. So, 2, it creates and issues these little ownership certificates, these shares of stock. 3, people like you and me, the investors, buy those shares, and that's how the company gets its money. And 4, in return for our cash, we become part owners, hoping that as the company gets bigger and more successful, our little piece of the pie gets a whole lot more valuable.
Okay, great. We know what a stock is, so now we get to the million-dollar question. How in the world do you choose which ones to buy? I mean, there are thousands of them. Well, while there are a ton of different strategies, they pretty much all fall into 2 big schools of thought. Let's check them out.
So on one side, you have what's called fundamental analysis. I want you to think of these people as business detectives. They're digging deep, looking at a company's health, its profits, its debts, its managers, to figure out what that company is really worth. Then, on the other side, you have technical analysis. These folks are more like chart psychologists. They're not so worried about the company's balance sheet, they are obsessed with the stock's price chart, believing that past patterns can give them clues about where it's headed next.
A fundamental analyst, that business detective, wants to know everything. They are asking these tough questions. They're poring over financial statements. They're researching the competition. They're even trying to figure out if the CEO is any good. They want to be absolutely sure the business itself is a winner for the long haul before they'll even think about buying a piece of it.
Now, technical analysts, they operate from a completely different belief. They think all that fundamental stuff, the earnings, the debt, the CEO, it's already baked into the stock's price. For them, this chart tells the entire story. So they study these price movements, the volume of shares being traded, looking for repeating patterns that they believe signal what's about to happen next.
But here's the thing. There's another force at work here, a really powerful one that you won't find on any chart or in any annual report. It's the one thing that can make all the logic and analysis in the world just fly right out the window. Human emotion. And it all boils down to these 2, fear and greed. They're the rocket fuel for the market's wild swings. Greed is what happens during a bubble, when everybody gets euphoric and thinks prices can only go up. And fear? That's what causes a market crash, when everyone panics and stampedes for the exit all at once. If you don't understand these 2 emotions, you'll never understand the market.
This brings us to a whole other kind of analysis, called sentiment analysis. This is all about trying to read the room, to gauge the collective mood of all investors. Is everybody wildly optimistic, or are they totally terrified? It's about understanding the herd. And here's the kicker from our source material. A lot of the time,
Once you figure out which way the crowd is running, the smartest move you can make is to calmly walk in the opposite direction. So, this is a question every single one of us has to ask ourselves, over and over again. It is just so easy to get swept up in the excitement when a stock is soaring, or to sell everything in a panic when the market drops. But the investors who really make it long-term, they're the ones who can shut out all that noise and think for themselves.
Speaking of making your own decisions, let's switch gears and get really practical. Because understanding market psychology leads right to understanding our own biggest hurdle, ourselves. Honestly, sometimes knowing what not to do is way more important than knowing what to do.
Now, this sounds almost ridiculously obvious, but it's maybe the most important rule of all. The whole point of this is to make your money grow, not shrink. So if you buy a stock and it just keeps going down and down and down, that's the market giving you a crystal clear signal that your original idea was probably wrong. Admitting that isn't failure, it's just smart. It's the first step to protecting your money. And here they are, the classic traps that our own brains set for us. We hang on to a losing stock because of hope. Oh, it'll come back. We let a stock that's doubled in price fall all the way back to where we bought it because of greed. We buy something just because our buddy told us to, which is pure herd mentality. The key takeaway here isn't just to be disciplined, it's to make a plan before you put your money in. Know exactly why you're buying and decide ahead of time at what point you'll sell, whether you're right or whether you're wrong.
Okay, we have covered a ton of ground. We've talked about what the market is, how to analyze stocks, and the psychological traps to avoid. So let's bring this all home with some final, timeless advice that can guide you from here.
I love this quote from the book because it's so powerful, and it has absolutely nothing to do with picking the next hot stock. It's about building a rock-solid financial foundation first. Think about it. Paying off a credit card with 20% interest is like getting a guaranteed 20% return on your money. No stock can promise you that. Before you even think about playing the Wall Street game, you have to get your own financial house in order. Period.
And this brings us right back to where we started. Remember that scary quote about Wall Street trying to take your money? Well, the single best defense you have, the one tool that truly levels the playing field, is knowledge. That brutal game starts to look a whole lot less scary when you understand the rules, you know who the players are, and you speak the language. What we've done here today, that's your first big step.
And so, that's the question we want to leave you with. Now that you know the rules of the game, what's your first move? Maybe it's paying off that last bit of debt. Maybe it's setting up an automatic savings plan. Or maybe it's just committing to learning more. Whatever it is, you're now in a much better position to make that decision with confidence. Your journey is just getting started, and honestly, that's the most exciting part. Thanks for hanging out with us.
Hello and welcome. You know how you hear people talking about the market all the time, and it feels like they're speaking a totally different language? Well, today, we're going to change that. We're diving headfirst into the world of the stock market, and I promise, by the time we're done here, it's not going to seem nearly as scary as you think.
So let's just rip the Band-Aid off. What is the stock market really? It's a term we hear everywhere, on the news, in movies, but what does it actually mean? It can feel like this huge, complicated machine, but honestly, at its core, the idea behind it is super simple.
You know what? The best way to get your head around it is to forget all the crazy charts and flashing numbers for a minute. Just picture the biggest swap meet or auction you can possibly imagine, but on a global scale. That's all it is. It's just a place where buyers and sellers come together to trade stuff. The only difference is, instead of old furniture or collectibles, they're trading tiny little pieces of companies.
So, to really get this, here's our roadmap for today. We're going to start with that whole big auction idea. Then, we'll do a quick time travel back to see where it all began. After that, we'll meet the people actually playing the game, figure out how anyone keeps score, and then wrap up with the most important part. What are the risks and what are the rewards for you?
All right, let's kick it off with Section 1, the world's biggest auction. So, if this thing is just a giant auction, what's actually being sold? Let's break down the absolute basics of what's on the table, and more importantly, why anyone even bothers to show up.
The things being auctioned off are called stocks. And a stock isn't just some digital number on a screen. It's a real, actual piece of ownership in a company. When you buy a share of stock, you literally become a part owner of that business. They even have a name for it. You're a shareholder. You've got a tiny claim on everything that company does from that point on. And this whole system is really just a two-way street. On one side, you've got the companies. They need money, or what the pros call capital, To do stuff, right? To hire people, build new factories, invent new things. To get that money, they sell off little slices of their company in the form of stock. And on the other side of the street, that's us, the investors. We buy those shares, giving them the cash they need, and in return, we're betting that the company will do well, which will make our little slice of ownership worth more money down the road.
And we're not talking about some obscure companies you've never heard of. These are the brands you probably interact with every single day. Think about it. We're talking about Microsoft, Disney, Coca-Cola, GM, McDonald's. The big takeaway here is that you're not just buying some random ticker symbol. You're investing in the future of real, tangible businesses.
And this right here is the bottom line. It's why people do this. The whole point is to eventually sell that stock for more than you paid for it. If you pull that off, the profit you make is called a capital gain. And if you end up selling it for less, well, that's a capital loss. It's really that simple. Okay, on to Section 2, from tree to tech. So how did this massive high-speed digital auction even come to exist? Well, the story starts in a way that's surprisingly old school, almost quaint. Let's take a quick look at how we went from a street corner to a global computer network.
It's pretty wild to think about. Long before anyone had a computer, traders would literally just meet up on the street, under a big buttonwood tree on a little path in New York that we now know as Wall Street. As things got busier, a group of 24 brokers decided they needed some rules. So in 1792, they signed the Buttonwood Agreement. And just like that, the New York Stock Exchange, the NYSE, was born. Now, let's fast forward nearly 200 years to 1971. The whole game gets flipped on its head when the Nasdaq launches as the world's first ever electronic stock exchange. No more shouting under a tree.
So, in the US today, these are pretty much the big three. You've got the NYSE, which is still seen as the home for the huge, established blue-chip companies. Then there's the American Stock Exchange, or AMEX. Fun fact, it was actually started by the traders who weren't invited to the original NYSE club. They were literally called curbside traders. And of course, there's the Nasdaq, which became famous as the go-to place for all the big tech companies.
Okay, Section 3, meet the market players. So we have our auction house, and we know what's being sold. But who exactly are the people doing all this buying and selling? Turns out there are a few different kinds of players in this game, and they all come to the table with totally different game plans.
This quote from Warren Buffett, probably the most famous investor on the planet, just perfectly sums up the mindset of the first type of player we're going to talk about, the long-term investor. This really breaks down the two main philosophies. On one side, you have the investor. They think like Warren Buffett. They care about the quality of the business itself, for the long haul. They'll buy a stock and hold on to it for years, maybe even forever, riding out all the daily ups and downs. Then, on the other side, you've got the short-term trader. They're not so worried about the company's 10-year business plan. They care about the stock's price right now, today. Their goal is to jump in and out, making money off of quick price swings, sometimes in a matter of minutes. And finally, you have the heavy hitters, the institutional traders. These are the giant banks, the pension funds managing retirement money for millions, the huge mutual funds. We're talking about people who are trading billions of dollars of other people's money. They're so big, a single move from them can change the direction of the whole market for a day.
All right, Section 4, how Wall Street keeps score. So think about it. You've got thousands of stocks, all trading every second of the day, with prices flying up and down. How on earth does anyone know if the market as a whole had a good day or a bad day? Well, they've got a system for that.
The answer is something called a market index. The easiest way to think about an index is like a poll or a quick snapshot. It just takes a specific group of stocks and averages them together to give us a super quick, at-a-glance idea of how things are going. Is the market generally trending up, down, or just kind of sideways? The index gives us the answer.
Now, there are tons of these indexes, but really, you just need to know the big three that you always hear about on the news. You've got the Dow Jones Industrial Average, that's the oldest and most famous one, the Dow. Then there's the Nasdaq Composite, which, you guessed it, tracks all the stocks on the Nasdaq. And finally, the S&P 500, which a lot of experts think is the best measurement of the whole US market, because it follows 500 of the biggest American companies.
But here's the wild thing, the little secret behind the most famous index in the world, the Dow. That one number you hear every night that supposedly tells you how the entire economy is doing? It's not tracking thousands of companies. It's just the average performance of 30. That's it. Just 30 huge, important companies that are chosen to represent a little slice of everything, from tech to retail, to act as a sort of daily checkup for the whole system. Okay, we've made it to our last section, the risk and the reward. We've talked about what the market is, where it came from, who's in it, and how we measure it. But all of that leads to the biggest question of all. So what? Why does any of this matter to you? Let's get into the good stuff, the potential rewards, and the very real risks.
Let's start with the reward side of the equation, because this is why people get into the market in the first place. If you look back over the last 75 years, historically, the stock market has returned an average of about 11% a year. Now, just compare that to what you typically get from a plain old savings account. That huge difference in potential growth is exactly why people see the market as a powerful tool for building wealth over time.
But, and this is a really big but, that reward is absolutely not a guarantee. There are serious risks. You've got market risk, which is when something big happens and the whole market takes a nosedive. You've got company risk, where the specific company you picked just doesn't do well. But look at those last two. There's also risk in doing nothing at all. Inflation risk is like a slow leak in your tire. It quietly eats away at the value of your cash year after year. And then there's opportunity risk, the risk of missing out on the growth you could have had because you decided to just sit on the sideline.
So at the end of the day, here's the main takeaway. There's no such thing as a choice with zero risk. Putting your money in the market comes with the risk that you could lose some of it, but leaving your money sitting in cash comes with the certainty that it will lose its buying power over time because of inflation. Understanding that trade-off, that's the real first step to making smarter choices for your own future. So the question isn't, how do I avoid all risk? It's, which risks am I willing to take to reach my goals? And hopefully now you're a little better equipped to start figuring that out.
So, let's jump right in. When I say the word investing, what's the first thing you think of? For almost everyone, it's that chaotic, exciting image of the stock market, right? Buying this, selling that. But here's the thing. Thinking that investing is only about picking individual stocks, that's like saying the entire world of music is just one single band. It's a huge part of it for sure, but it's just one instrument in a much, much bigger orchestra. Today, we're going to explore that whole orchestra.
Here's how we're going to do it.
First, we'll talk about the huge risk of putting all your eggs in one basket. Then, we'll start filling up our investor toolkit piece by piece. We'll look at bonds, mutual funds, and even things like cash and real estate. After that, we'll learn how to read the general mood of the market. And finally, we'll pull it all together so you can stop thinking like a stock picker and start thinking like a true portfolio builder.
Okay, so let's start with the big problem, the why behind all of this. It's the incredible and honestly often overlooked danger you're in when you tie your entire financial well-being to the fate of just one single company.
Let's just put the question out there, point blank. Is it ever a good idea to pour all of your hard-earned money into one stock? You know, the temptation is real. We've all heard those stories, right? Somebody bought a tech stock back in the day and became a millionaire overnight. It's like the lottery ticket of investing. But here's the reality. That dream can turn into a nightmare really, really fast.
Just look at this. What's truly terrifying here isn't just the number, it's the speed. Over 90% in one day. This isn't a slow decline, it's a financial cliff. This was WorldCom, a company that seemed totally unstoppable. Then they got caught in a massive accounting scandal. Imagine you were an employee with your life savings in that company's stock. You went to bed one night feeling secure, and you woke up the next morning with practically nothing left. That is what happens when all your eggs are in one basket, and that basket just completely disintegrates.
All right, so how do we protect ourselves from that kind of disaster? Let's grab our first tool from the toolkit, and this one requires a complete shift in how you think. See, if stocks are about being an owner of a company, bonds are all about being the lender. You're not gambling on massive growth. You're the one providing the stable cash that makes growth possible in the first place, and you get paid reliably for doing it.
At its core, a bond is actually super simple. It's an IOU. It's a formal written promise. You're basically acting like the bank. You lend your money to a big organization, could be a company, could be the government, and they give you a contract. And that contract basically says, hey, thanks for the loan. We're going to pay you a set amount of interest, say every 6 months, and then on a specific date down the road, we'll give you your original money back. That's it. It's a predictable, steady income stream.
So who can you lend to? Well, there are kind of three main flavors. First up, you've got treasuries. This is you lending money to the U.S. government. They're considered the safest of the safe because they're backed by, well, the entire U.S. government. Then you have what are called munis, or municipal bonds. This is you lending money to your city or state to build a new hospital or fix a bridge. And the cool part is, the interest you earn is often tax-free. And finally, you have corporate bonds. This is you lending to companies like Apple or Microsoft. Of course, there's more risk than with government bonds, but to make it worth your while, they pay you a higher rate of interest.
But And this is important. Being the bank isn't totally risk-free. The company you lend to could go broke. Remember WorldCom? They had bonds too. This is called default risk. And to help us figure out how risky a bond is, rating agencies give them a grade, just like in school, from the super safe AAA all the way down to what are colorfully called junk bonds. And this brings us to the fundamental rule of investing. The riskier the borrower, the higher the interest rate or yield they have to pay to convince you to lend them your money.
Okay, this next part can feel a little backward at first, but stick with me, it's super important. Think of a seesaw. On one side, you have the value of the bond you already own. On the other side, you have the current interest rates out in the world. When interest rates in the market go down, the value of your bond goes up. Why? Well, because your bond is now paying a higher interest rate than any of the new bonds being sold, so it suddenly looks way more attractive. The opposite is also true. If interest rates go up, your older, lower-paying bond isn't as appealing anymore, so its market value goes down. They always move in opposite directions.
All right, so we've got stocks for ownership and bonds for lending. But picking individual ones is still a ton of work, and as we've seen, it can be risky. So, what's the shortcut? Well, let's grab the next tool in our kit, which is the ultimate way to get instant diversification, the mutual fund.
You know, the best way to think of a mutual fund is like an investment potluck dinner. Instead of you having to cook 100 different dishes yourself, you just chip in $20. Thousands of other people chip in their $20, and suddenly you have this massive pile of money. Then a professional chef, the fund manager, takes all that cash and buys a huge, diversified buffet of hundreds, sometimes thousands of different stocks and bonds. With one single purchase, you become a tiny owner of that entire buffet. It's amazing.
And this is why that potluck idea is so powerful. Let's go back to that WorldCom disaster for a second. If you owned the stock directly, you lost 90% of your money. It was a catastrophe. But if you owned a broad mutual fund that just happened to own a little bit of WorldCom stock, well, WorldCom was just one tiny crouton in your giant salad bowl. When it went bad, maybe your whole fund dropped by, 3% that day? That's the difference between financial ruin and a little bump in the road. That is the power of diversification.
Now, not all funds work the same way. You've basically got two main camps. On one side are the actively managed funds. This is where you have a fund manager, a supposed genius, who's constantly buying and selling, trying to outsmart the market. And all that extra work, it costs you more in fees. Then you have index funds. Their goal is much simpler. They don't try to beat the market, they just try to be the market. They just buy and hold every single stock in a big index, like the S&P 500. There's no genius manager, just a simple formula. And because of that, their fees are way, way lower.
And there's one more really important distinction you have to know: load versus no load. A load is just a fancy word for a sales commission you have to pay just to buy into the fund. A no-load fund has no sales commission. It's that simple. Think about it. Why would you pay a cover charge to get into a party when the exact same party is happening next door for free? Research shows there's no evidence that load funds perform any better. So choosing a no-load fund just means more of your money is actually invested right from the start, instead of lining the salesperson's pocket.
Okay, so we've got our foundation with stocks, bonds, and funds, but a really strong portfolio has a few other tricks up its sleeve. Let's talk about our last set of tools: cash, which is your ultimate safety blanket, and real estate, a totally different way to think about growth.
Now, when we say cash, we don't mean wads of bills under your mattress. We're talking about a whole category of super safe, easy-to-access investments. Things like a high-yield savings account, a CD, or really short-term government debt. Yeah, the returns are low, but that's not the point. Cash has two jobs: defense and offense. It's your shield when the market is falling apart, and it's your dry powder, the ready money that lets you jump on great opportunities when everyone else is panicking.
And here you can see how it all comes together. A truly diversified portfolio isn't 100% in any one thing. It's a recipe with different ingredients. This is just an example, but you see it's got stocks for growth, bonds for income, real estate for another kind of growth, and cash for safety. Your personal recipe will be different, of course, depending on your goals and your age, but the main idea is the same. Don't bet the farm on just one ingredient.
So how do you get real estate into that recipe? Well, you've got two main options. You can go the traditional route, buy a physical property, become a landlord, deal with tenants and toilets, and hopefully get some nice tax breaks. But it's a lot of work, and your money is tied up. You can't sell a house in 5 minutes. The other option is something called a REIT, a real estate investment trust. These are just companies you can buy on the stock market that own and manage huge portfolios of property, office buildings, shopping malls, you name it. You can buy and sell shares just like a stock, so it's a super easy, no-hassle way to be a real estate investor. So, your toolkit is now full. You've got all these different tools. But here's the thing. You wouldn't use a hammer to saw a board, and you wouldn't start building a deck in the middle of a hurricane. Knowing which tool to use, and just as importantly, how to feel about your strategy, depends on understanding the overall financial weather. So let's learn how to read the forecast.
First up, you've got the bull market. These are the good times, right? The sun is shining, the economy feels strong, and stock prices are just climbing and climbing. Everybody's optimistic. The main feeling in the air is FOMO, fear of missing out, because it feels like everyone is making money and the party is never going to end.
And then you have the opposite, the bear market. This is the storm. The news is all bad, the market is falling day after day, and the mood shifts from optimism to straight-up fear. People are rushing to sell everything. This is when having a solid, long-term plan is really put to the test.
And finally, there's the sideways market. And honestly, this can be the most frustrating one of all. The market's not really crashing, but it's not going up either. It's just stuck. It can drift along for months, even years, without going anywhere. This market tests your patience more than anything else, making you wonder if your plan is even working.
And that brings us to the whole point of this. The goal of understanding all these tools and all these market moods is to help you make a really important shift in your thinking. It's about graduating from the high-stakes, stressful gamble of being a stock picker to the calm, strategic, and much more powerful role of a portfolio builder.
So there you have it. The entire toolkit is laid out in front of you. You've got bonds for the solid foundation, mutual funds to build the diversified structure, cash for your safety systems, and real estate as a unique addition. All the pieces are there. You now have the blueprints to build something strong, something that can handle the inevitable storms and grow for a lifetime. The only question left is, what are you going to build?
You know, the stock market can feel like this huge chaotic universe, right? There are literally thousands of companies out there. But what if you had a map? Well, today, we're going to dive into how to classify stocks. Think of it as a way to bring some order to that chaos and, more importantly, to help you find your own way as an investor. Okay, but before we even get into the stocks, let's start with a question for you. Seriously, what kind of investor are you? Are you a cautious planner, someone who's looking for stability above all else? Or maybe you're a bargain hunter, always searching for that hidden gem. Or are you a futurist, someone who's willing to bet on the next big thing? You see, understanding how stocks are classified is really about understanding yourself. So here's our roadmap for today. We're going to start with the big picture, our map of the market. Then we'll zoom in on these different investor mindsets, from the super cautious to the high-stakes gambler. And yeah, we'll even meet the watchdog that's supposed to keep everyone honest. First up, let's unfold that map. The first and maybe the most fundamental way to classify stocks is by their sector. Just think of it like organizing a giant city into different neighborhoods. Each one has its own vibe, its own character, and its own economic pulse. So what exactly is a stock sector? It's pretty simple, really. It's just a group of companies that are all in the same line of work. They make similar stuff, they offer similar services, and because of that, they often face the exact same economic challenges or get the same boosts. And wow, the diversity here is just massive. I mean, you've got sectors like airlines, which are super sensitive to things like fuel prices and travel habits. And then you have something like pharmaceuticals, which moves on these long research and development cycles. Each one is its own little economic ecosystem, reacting to different things in totally unique ways. And this right here is the whole ballgame. It's why sectors matter so much. The economy is never just one single story. For example, just think back to the early 2000s. The tech bubble had just burst, and sectors like computers and the internet were just getting hammered. But at the exact same time, investors who were paying attention noticed that retail and housing were actually booming. So knowing the sectors gives you a massive clue about where the money is actually flowing. All right, let's zoom in and meet our first investor type, the cautious planner. This is someone who really values stability and a predictable stream of cash. Maybe they're getting close to retirement. Their favorite neighborhood in the market? Well, that's the world of income stocks. Income stocks are all about one word, dividends. These are shares in companies, usually big, stable, established ones, that have decided to literally share their profits directly with their shareholders. It is like getting a regular paycheck in the mail, just for owning a piece of the company. Okay, but it's not all sunshine and rainbows, right? The pros are pretty clear. You get regular income, and these stocks tend to be less of a roller coaster. That dividend check can feel pretty good when the stock price itself takes a dip. But on the flip side, you do have to pay taxes on that income. And if inflation is high, it can eat away at the value of those payments. And make no mistake, if the entire market crashes, these stocks can still go down with it. But what does this actually look like in your bank account? I mean, a few cents per share might not sound like a big deal, but when you start to scale it up, the numbers can get pretty serious pretty fast. Okay, let's make this real. Let's say you own 5,000 shares of a company, and that company pays out 25 cents a share every quarter. Well, that adds up to $1 per share for the year. The math is simple. 5,000 shares times $1, that's $5,000 in your pocket, just for being a shareholder. That's the real power of income investing. Next up, let's meet the bargain hunter. This type of investor absolutely loves digging through the financial clearance rack. They're not looking for what's popular or trendy. They're looking for what's misunderstood and, most importantly, underpriced. They are hunting for value stocks. So a value stock is a company that, according to the bargain hunter's homework, is trading for way less than it's actually worth. Now, the big challenge, of course, is figuring out that true worth, or what they call intrinsic value. It's really part art, part science. You're basically trying to find a dollar bill that someone is selling for 50 cents. So what do these companies look like? Well, a lot of the time, they're not the flashy names you see in the headlines. They might be kind of boring businesses, like banks or insurance companies that the market has just temporarily forgotten about, maybe because of one bad piece of news. But finding them isn't easy. It takes serious research. Investors will use tools like the price to earnings or PE ratio to compare a company's stock price to its actual profits. It helps them prove that it's a real bargain and not just, cheap for a good reason. All right, let's do a complete 180. From hunting for today's bargains, let's shift to an investor with a totally different mindset, the futurist. This person couldn't care less about today's price. They are focused entirely on tomorrow's potential. They are willing to take on a lot of risk for the chance of absolutely astronomical rewards. And they do this by investing in growth stocks. Growth stocks are companies that are just expanding at a blistering pace, often in super innovative fields like technology. Investors are willing to pay a high price for these stocks right now, not because of their current profits, sometimes there aren't any, but because they believe that company is going to dominate its industry and make massive profits down the road. This hope, this bet on the future, is also what makes them incredibly volatile. So let's put these two side by side, because the difference is night and day. Growth investing is all about future potential. It's high risk, and these companies almost never pay dividends because they're plowing every single penny back into growing the business. Think about companies like Cisco and Dell back in the 90s. Value investing, on the other hand, is all about today's bargain price. It's more moderate risk, and it focuses on established industries. We're talking two totally different philosophies. Okay, deep breath. We've talked about the main strategies. Now we have to venture into the wild west of the stock market. And let me be clear. This isn't really about investing. This is about gambling. This is a cautionary tale about penny stocks. Just like the name suggests, these stocks are cheap. They often trade for less than $5 a share, and sometimes for literal pennies. They're so small and unproven, they don't even qualify for the major stock exchanges. So why are they so dangerous? Well, because almost nobody trades them, which means their price is incredibly easy for scammers to manipulate. And this is what it sounds like when the trap is being set. You get a phone call out of the blue from somebody you've never met, and they're painting this picture of a once-in-a-lifetime opportunity. The math sounds amazing, the pressure is on, and the promise, well, it's intoxicating. This is the sound of what they call a boiler room operation. Let me break down exactly how this scam works. It's a classic playbook called a pump and dump. First comes the hype. A team of brokers just starts cold calling people to create fake demand for a nearly worthless stock. Second is the pump. As all these unsuspecting buyers start driving the price up, the insiders who already own the stock sell everything, making a fortune. And finally, the dump. The hype disappears overnight, the price completely collapses, and every single person who bought in is left holding a worthless investment. After a story like that, you might be wondering, is there anyone out there looking out for the little guy? And the answer is yes. So let's meet the investor's watchdog. This is your first line of defense against this kind of fraud. This is the U.S. Securities and Exchange Commission, or the SEC. It was created way back in 1934, right after the Great Crash of '29. And its entire mission is to be the police officer for Wall Street. It sets the rules, it enforces them, and it works to make sure the markets are run fairly and honestly. And its primary goal is to protect individual investors, people just like you, from the kinds of scams we just talked about. And that really brings us to our final thought. Whether you see yourself as a cautious planner, a bargain hunter, or a futurist, the market is always going to be a landscape of both opportunity and risk. And while regulators like the SEC provide a crucial safety net, in the end, your ultimate defense, the most powerful asset you will ever have, is your own knowledge. Understanding the game is always the first and most important step to winning it. Hello and welcome. Today we're going to talk about the more active side of investing, all the strategies and ideas that go way beyond just buying a stock and hoping for the best. We're going to look at how you can actually engage with the market and, maybe even transform your whole approach to investing. So let's start with that big question right there. Is investing just a passive waiting game? Do you just buy a stock, cross your fingers, and see what happens? And hey, while that can be a strategy, it is so far from the whole story. There's a whole world of things you can do, and today we're going to explore some of the most interesting ones. All right, so let's get into it. Think of this as building your very own investor's toolbox. First, we're going to lay the groundwork, building a solid foundation to manage risk. Then, we'll get into the power of compounding and how it can really kick your growth into high gear. We'll also look at the psychology behind something called stock splits, a move that companies make all the time. After that, we'll explore a really counterintuitive idea, how to profit when a stock's price actually goes down. And finally, we'll learn how to read a stock's basic blueprint to really understand what you're looking at. Okay, let's start with maybe the most critical tool in the entire toolbox, building that strong foundation for your investments. This is all about managing risk, making sure that one bad bet doesn't sink your whole ship. And the cornerstone of that foundation is something called diversification. You've heard the old saying a million times, right? Don't put all your eggs in one basket. Well, that's exactly what this is. By spreading your money across different companies, different industries, even different types of assets, you're creating a safety net. So if one part of your portfolio takes a hit, another part might be doing great, which helps balance everything out. And if you ever need a reason why this is so important, just look at the devastating real-world story of Enron. You see, many of their employees had their entire life savings, everything, invested in Enron stock. So when the company collapsed because of massive fraud, they didn't just lose their jobs. They lost their entire retirement savings. It's a tragic but absolutely vital lesson on the importance of spreading your risk. So once you get the whole don't put all your eggs in one basket idea, the next logical step is asset allocation. This is where you actually decide on the right mix for your portfolio. It's about figuring out what percentage of your money goes into different categories, like, say, stocks for growth, bonds for a more stable income, and cash for things you might need right away. And this here is a great example of what that might look like for, say, a 30-year-old investor. Look, with decades to go before retirement, they can afford to take on more risk to get higher returns. That's why their portfolio is so heavily weighted towards stocks. They've got plenty of time to ride out any bumps in the market. Now, on the flip side, someone who's about to retire would probably have a much more conservative mix, way more in bonds and cash, to protect what they've built. It really all depends on you and your tolerance for risk. All right, now for our second tool. This is a concept that, honestly, might be the most powerful engine for building wealth that exists in finance. We're talking about the magic of compounding. Let's break down how this incredible thing works with a super simple example. Let's just imagine you invest $100. Okay, so after 1 year, let's say your investment grows by 10%. You've now got your original $100 plus $10 in profit, giving you a grand total of $110. Simple enough, right? But here is where the magic really happens. In that second year, the 10% growth isn't calculated on your original $100 anymore. No, it's calculated on the new total of $110. So you earn $11, not $10. That extra dollar, that's your earnings earning their own earnings. It's like a snowball rolling downhill. It starts small, but it grows exponentially over time. So the big takeaway here is that by just reinvesting what you earn, your money starts to do all the heavy lifting for you. As the legendary founder of Vanguard, John Bogle, once said, it's the greatest mathematical discovery of all time for the investor seeking maximum reward.
in the single most important ingredient you need, time. The earlier you start, the more powerful this compounding effect becomes.
Our next tool is a bit different. It's less about the hard numbers and more about, well, human psychology. We're talking about the stock split. It's this fascinating thing companies do to influence how we perceive their stock without actually changing its value one bit. So, how in the world does a stock split work? Well, in a 2-for-1 split, the company literally doubles the number of shares you own, but at the same time, it cuts the price of each share in half. So, as you can see right here, if you add 100 shares at $80 each, you'd suddenly have 200 shares at $40 each. Do the math, the total value of your investment is exactly the same, $8,000. So if the value doesn't change, you're probably asking, why even bother? Well, it all comes down to perception. A $40 stock just feels more accessible, more affordable than an $80 stock. It's a psychological trick that can bring in new investors who might have been scared off by that higher price. It's also kind of a signal from the company that they're confident the price will keep going up. And there's a really practical reason for these splits, too. Just take a look at Warren Buffett's company, Berkshire Hathaway. They have this famous policy of not splitting their main Class A stock. And the result? A single share will cost you hundreds of thousands of dollars. So splits really do make ownership way more accessible for the average person who doesn't have that kind of money just lying around. Okay, now we're going to move into some more advanced stuff with a strategy that honestly feels completely backwards at first. We're going to talk about how you can actually make money when a stock's price goes down. This is called short selling. Now, the mechanics can be a little confusing, so let's walk through it nice and slow. Instead of the usual buy low, sell high, with shorting, you sell high, then buy low. First, you borrow shares of a stock you think is way overvalued. Let's say you borrow 100 shares when they're at $50 each. Second, you immediately sell those borrowed shares on the market, pocketing $5,000. Third, if you're right and the price drops to, say, $40, you then buy back 100 shares for just $4,000, return them to the person you borrowed them from, and you've just made a $1,000 profit. Now, this is maybe the most important part to understand. The risk of short selling is immense, and it is not symmetrical. When you buy a stock, the absolute most you can lose is whatever you put in. The price can only go down to zero. But when you short a stock, your potential loss is, theoretically, unlimited. There is no ceiling on how high a stock's price can go, and since you have to buy it back eventually, you could be on the hook for a truly massive loss. And this is a perfect and painful illustration of those dangers. Back in the dot-com bubble, a lot of investors thought Yahoo was insanely overpriced at $90 a share, so they decided to short it. And you know what? They were eventually right, but their timing was a complete disaster. The stock first rocketed up past $400 a share, forcing all those short sellers to buy the stock back at catastrophic losses before it finally crashed. It's a brutal reminder that with shorting, being right isn't enough. You also have to be right at the right time. Okay, for our final tool, let's look at how to read a stock's basic blueprint. These are the key numbers that act like a company's vital signs, giving you a quick snapshot of its size, its value, and how its shares are actually traded out there on the market. There are 3 key terms you'll want to get familiar with. Outstanding shares is pretty simple. It's just the total number of shares a company has issued. The float is a bit more specific. It's the number of those shares that are actually available for the public to trade once you subtract all the shares held by insiders. A small float can mean a stock is much more volatile since a few big trades can really move the price. And finally, you have market cap. You just multiply the outstanding shares by the stock price. It's the quickest way to get a sense of a company's overall size. And all of this brings us to IPOs, or initial public offerings. That's when a private company sells shares to the public for the very first time. And wow, IPOs can be exciting, but they can also be incredibly volatile. Just take a look at the story of VA Linux during the dot-com bubble. Its IPO price was set at $30 a share. On its very first day of trading, it exploded over 700% to almost $300 a share. But that hype did not last. A few years later, the stock was trading for less than $5. It's a really dramatic example of the kind of hype and risk that can surround a brand new public company. So there you have it. We've just added 5 powerful tools to your investor's toolbox. From building a solid foundation with diversification, to harnessing the incredible power of compounding, to understanding the psychology of stock splits, we've also explored the high-stakes game of short selling and learned how to read a company's basic blueprint. Each one of these tools gives you a whole new lens to see the market through and a new way to engage with your investments. So the journey of learning never really ends.
And the real question is, which one of these concepts are you going to explore further? Thanks for joining us.
You know, it's easy to think that all you need to know about a stock is its price. But that number, well, it's just one little piece of a much, much bigger puzzle. Today, we're going to pull back the curtain and demystify what a stock price really tells you, and maybe more importantly, what it doesn't. So let's dive in.
All right, so you pull up a stock quote on your phone, you see a number pop up, $15.04. Seems pretty simple, right? That's what it costs. But hold on, what is that single number actually telling you? Is that the price to buy, the price to sell? Is it even the most current price?
Well, the truth is, that number tells you way less than you'd imagine. In fact, if you really want to get smart about investing, you have to learn to look right past that price to the really juicy data that's hiding just underneath. Often, the most important numbers have nothing to do with the price itself.
Okay, before we even dig into price, we've got to talk about how we identify a stock in the first place. Every single publicly traded company has its own unique code, and learning to read it is like learning the secret handshake of the market.
This code is what we call the ticker symbol. Some are super simple, right? GE for General Electric. Others are a little longer, like MSFT for Microsoft or CSCO for Cisco. You'll find that most seasoned investors actually talk in tickers. It's just the universal shorthand for the stock market. It's way faster.
Now here's where it gets really interesting. These little codes, they've got a hidden clue baked right into them. Just by glancing at a ticker symbol, without knowing a single other thing about the company, can you guess which major stock exchange it trades on? The answer is yes, and the trick is incredibly simple.
And here it is. This is the hack. All you have to do is count the letters. If the ticker has 1, 2, or 3 letters, think GE or T for AT&T, it's on the big board, the New York Stock Exchange, the NYSE. If it's got 4 or 5 letters, like our Microsoft or Cisco examples, it's on the Nasdaq. It's just a quick and dirty rule of thumb to know where the action is happening.
All right, so we've got the ticker down. Now let's get back to that price. But like we said earlier, it's not as simple as just one number. It's time to actually perform an autopsy on a stock quote and see what's really happening behind the scenes.
And here is the first big reveal. That single price you see flashing on the news, that's usually just the price of the last trade that happened. When you pull up a real detailed quote, you'll almost always see two prices, not one. There's a slightly higher one and a slightly lower one, and these two numbers are everything. They represent the two sides of every single transaction.
So, the first price is the bid. The easiest way to think about this is that it's what buyers are currently bidding to pay for a share. So if you own the stock and you want to sell it right this second, the bid price is what you're going to get. It's always the lower of the two prices.
And on the flip side, you've got the ask price. This is what current owners are asking for their shares. So if you want to buy the stock right now, the ask is the price you're going to have to pay. And it's always the higher of the two. So remember, you buy at the higher ask price and you sell at the lower bid price.
Now that tiny little difference between the bid and the ask, that's called the spread. Here, for Cisco, it's just 2 cents. This spread is basically the cost of doing business. And for you, the investor, a smaller spread is always, always better. And honestly, thanks to computers, these spreads are often just a penny or two these days, which makes the market way more efficient than in the old days when spreads could be $1 or more.
Okay, so bid and ask. That's a huge leap forward from just looking at a single price. But a proper, detailed quote, man, it is a gold mine of information. It gives you a much richer picture of what's actually going on with a stock.
So besides the bid and ask, you'll see other key numbers, the day's range and 52-week range. They show you the price swings over a day and a year, giving you a feel for its volatility. Volume is so important. It tells you how many shares are changing hands. It's a great proxy for investor interest. Market cap tells you the total size of the company. Are we talking about a giant or a little guy? And finally, the PE ratio, or price to earnings. This is a huge one, and it's your first step toward figuring out if a stock is actually cheap or expensive compared to its profits.
And that PE ratio, it leads us right into what is probably the single most important idea in this whole explainer. We've learned how to read the price. Now let's talk about how to think about it. This is the game-changing difference between price and value.
So let me ask you this. You see two stocks. Stock A is trading at $10 a share. Stock B is $50 a share. Which one is the better deal? It's a trick question, of course, because the share price, by itself, tells you almost nothing about whether something is a real bargain.
Just look at this breakdown. Stock A is cheap at $10, right? But the company is drowning in debt and barely making any money. Stock B costs 5 times more per share, but it's a rock-solid business with strong profits. In this scenario, the $50 stock is almost certainly a much, much better value. Remember, price is what you pay, value is what you get.
The master of this idea, Warren Buffett, he put it perfectly. He said this: what he means is that the quality of the business is what really matters. You're better off paying a fair price for a truly great company than getting a so-called bargain on a mediocre one.
And to paraphrase Oscar Wilde, you don't want to be a cynic who only looks at the stock price. That's knowing the price of everything but the value of nothing. A real investor digs deeper to figure out the true value of the business hiding behind that ticker symbol.
All right, let's wrap up with a quick pro tip that builds on something we mentioned earlier: volume. A lot of new investors get excited about the idea of trading after the market closes, but let me tell you, it's a playground full of hidden traps.
Remember we talked about volume, the number of shares traded? Well, just look at this chart. The difference is staggering. During the day, you might see billions of shares trade hands, but in the after-hours market, that number just collapses, down to maybe a few million. The pool of buyers and sellers just completely dries up. So why does that matter so much? Because when there are so few people trading, prices can do some really wild and unpredictable things. A single, not-so-huge order can send the price swinging in a way that would just never happen during the regular trading day.
So the bottom line is, after-hours trading is a tricky, risky game. You're dealing with low liquidity, which means it's harder to get in or out. Those bid-ask spreads we talked about, they often get way wider, which costs you money. It all adds up to a much higher chance of you getting a really terrible price. For most people, the best advice is simple: just stick to regular market hours.
So what's the big idea here? What's the main takeaway? It's that the stock price you see on TV, that's just the first sentence of a much bigger, more interesting story. Think of it as an invitation to do a little digging and find out what's really going on.
So now you know how to decode the ticker. You know how to read the bid and the ask, and most importantly, you know how to think about value instead of just price. So the next time you look up a stock quote, what's going to be the first thing you check beyond that headline price? Is it the spread, the volume, maybe that PE ratio? Your answer will tell you that you're already starting to think like an investor.
So you're ready to start investing. You've heard all the buzz, you've seen the news, but now you're at the starting line asking, okay, how do I actually buy a stock? It can feel like this big, complicated wall, but honestly, it's not. In this explainer, we're going to break down the exact practical steps to get you off the sidelines and into the market so you can start your journey with real confidence. Here's the honest truth about investing. The actual clicking of buttons to buy and sell, that's the easy part. Anybody can do that. The real challenge, the part that takes a little bit of know-how, is actually making money doing it. And that's a huge distinction. So where do we begin? We start by building a solid foundation, understanding the tools of the trade before you even think about clicking buy. The first question pretty much everyone asks is, so how much money do I really need to get started? And while, yeah, you can technically start with less, our source material suggests a good starting point is somewhere around $5,000. So why that number? Well, it's because that amount gives you enough breathing room to build what's called a diversified portfolio. It just means you can spread your money across a few different companies. It's a way to manage your risk, right? Because if one stock takes a nosedive, hopefully the others can help pick up the slack. So here's our game plan for building that foundation. First, we're going to talk about the biggest decision you'll make right out of the gates: choosing your brokerage. Then we'll get into the nitty-gritty of how you actually place an order and what all the lingo means. After that, a super important warning about a common trap called margin. And we'll wrap it all up by looking at some really powerful lessons from history that every single investor needs to hear. All right, let's dive into that first major decision: picking a brokerage. Think of this as your gateway to the stock market. It's the company or the platform that's going to handle your trades. And as you're about to see, there are two very, very different paths you can go down. On one hand, you've got your traditional full-service brokers. The classic Wall Street firms that give you personal advice, tons of research, the whole shebang. But that white-glove service comes with a hefty price tag. Commissions can be hundreds of dollars per trade. On the other hand, you've got the online brokers. With them, you're the pilot. It's a do-it-yourself approach, which is absolutely perfect if you're watching your costs and you feel pretty comfortable making your own calls.
And this brings up a really important point about the full-service model, a potential conflict of interest. See, because many brokers get paid by commission, they might be tempted to get you to trade more often, not because it's good for you, but because it makes them more money. When that gets out of hand, it's an illegal practice called churning. It's something you just have to be aware of when you're paying someone for advice. This whole world of cheap online trading we take for granted today, it didn't just pop up overnight. It was actually born out of a crisis. Back in the big market crash of 1987, the old system of calling your broker on the phone completely fell apart. The lines were jammed, and regular people were totally locked out. So, in response, Nasdaq created something called SOES. It was a computerized system just for small individual orders. For the first time, everyday investors had a direct electronic way to trade. And that little system was the spark that ignited the online trading revolution. Okay, so you've picked a brokerage, you've put some money in your account. Now for the exciting part, placing your very first order. You might be imagining some complicated, stressful process, but honestly, modern online platforms have made it ridiculously easy. It really just boils down to 4 simple steps. 1, you put money in the account. 2, you type in the company's ticker symbol and how many shares you want. 3, you pick your order type. We'll get into that in a second, but for now, let's just say market order for a quick purchase. And finally, 4, you hit submit. That's it. The computer takes over and makes the trade for you, like instantly. Now, here's a fantastic little pro tip from our source. The first 30 minutes and the last 30 minutes of the trading day are often the craziest. Prices can swing all over the place because that's when a lot of the big institutional traders are making their moves. As a new investor, it's probably a smart move to just stay away from that chaos. Place your orders during the calmer middle part of the day. Okay, we have to talk about something called order types. This is basically you telling the market exactly how you want to buy or sell a stock. It's not just what you buy, but how you buy it. And learning this simple vocabulary gives you way more control over your investments. The most basic one is the market order. This is you saying, I want this stock right now, and I'll pay whatever the going rate is. The source uses a great analogy. It's like walking into a car dealership and saying, I'll take it, give me the keys, and paying whatever is on the sticker. You're prioritizing speed and the certainty that you'll get it, but you're not trying to haggle on price. The flip side of that is a limit order. This is where you get to be the negotiator. With a limit order, you're saying, I'm only willing to buy this stock if the price drops to X or lower. You get total control over the price you pay. But, and here's the catch, the stock might never hit your price. Your order could just sit there unfilled forever. So you're trading that certainty of buying it for control over the price. So there it is, the big trade-off. Market order is all about speed and certainty. You are guaranteed to get your shares right now. A limit order is all about price control, but you give up that guarantee. One isn't better than the other. They're just different tools for different jobs. All right, now let's talk about playing defense. A stop-loss order is a tool for managing your risk after you've bought a stock. You're basically setting up an automatic trigger with your broker that says, hey, if this stock ever falls to this specific price, just sell it for me. Get me out. The whole idea is to stop a small loss from turning into a giant one. It's kind of like an insurance policy on your investment. But, and this is a big but, not everyone loves stop-loss orders. The main argument against them is that for long-term investors, normal, everyday market wobbles might accidentally trigger your sale, forcing you to sell at a low right before the stock bounces back. If that happens over and over, all those little losses can feel like, well, death by 1,000 cuts, just slowly bleeding your portfolio dry. It's definitely a debated strategy. Okay, we've covered the basics of buying. Now we need to have a serious talk about a tool that most brokerages are going to offer you. It's a tool that our source material basically screams at beginners to avoid. And that tool is called margin. So what is margin? Simply put, it's borrowing money from your broker to buy more stock. Let's say you have $2,000. They might lend you another $2,000, so you can buy $4,000 worth of stock. This is also called leveraging. And yeah, it sounds amazing because it can double your potential profits. But, and you knew there was a but coming, it also doubles your potential losses. It's an incredibly dangerous double-edged sword. So let's paint a picture of how this goes wrong. You borrow that money, you buy your stock, and then the stock tanks. Suddenly, the stock you used as collateral isn't worth as much. Your broker gets nervous and hits you with a margin call, a demand for you to put more cash into your account right now. And if you can't come up with the cash, they have the right to just sell your shares at that rock-bottom price to pay off your loan. It can wipe you out.
And this isn't just some theoretical horror story. This exact scenario played a massive role in one of the worst financial disasters in history, which is exactly why looking at the past is so critical for protecting yourself in the future. I'm talking about the great stock market crash of 1929. One of the main reasons it was so devastating was the insane amount of margin people were using. Back then, you could borrow up to 9 times your own money. It was a house of cards. When the market finally turned, all that leverage was like pouring gasoline on a fire. The crash was catastrophic, and the Dow ended up losing nearly 90% of its value. It was so bad that the government stepped in and created the SEC, in large part to put strict rules on this kind of borrowing. And just to let the scale of that sink in, imagine you bought stocks at the peak in 1929. You would not have gotten your money back until 1954, 25 years, a quarter of a century. It's just a brutal reminder that the consequences of wild speculation and dangerous tools like margin can last a lifetime. So let's wrap this all up into a simple checklist for your first steps. Number 1, choose your broker based on what you need, not what someone else tells you. 2, get to know the difference between a market, a limit, and a stop order. 3, understand that margin is basically rocket fuel for losses. Stay away from it as a beginner. 4, learn from history so you're not doomed to repeat it. And finally, the most important rule of all, only, and I mean only, invest money you can actually afford to lose. So there you have it. We've gone over the how to open an account, how to speak the language of the market, and how to avoid the big historical traps. The mechanics, the buttons to click, that's not a mystery anymore. The real work, the real journey of making smart decisions, that starts now. So the question isn't, where do I buy stocks anymore? It's this. You've got the tools. What are you going to build with them?
So you're ready to dive into the stock market. You're faced with one huge question right off the bat. What's your strategy? Look, there's no magic formula here. It's really about finding a game plan that actually fits who you are and what you want to achieve. So how do you even start to build one? Well, let's break down the options.
I mean, it's a lot, right? You've got literally thousands of companies to pick from, a constant fire hose of news, and prices bouncing around every single second. If you just jump in without a plan, it is so easy to get lost. That's exactly where a strategy comes in. Think of it as your compass. It helps you make decisions with a purpose instead of just, throwing darts at a wall.
Okay, before we get into any specific strategies, let's lay down 3 really important ground rules. First, you can have the most brilliant strategy in the world, but if you don't have the discipline to follow it, it's completely worthless. Second, a plan that makes you look like a genius in a booming market might absolutely destroy your portfolio in a downturn. You got to be flexible. And third, at the end of the day, the only thing that tells you if it's working is your account balance. The numbers don't lie.
So here's our roadmap for today. We're going to start with the long game in the Patience Playbook. Then we'll go hunting for deals with the Bargain Hunter's Guide. After that, we'll catch a wave with the Momentum game, check out a really systematic approach called CanSlim, and then wrap it all up by helping you figure out how to find the path that's right for you.
All right, first up, let's talk about the strategies that are all built on one thing: patience. These aren't about making a quick buck. This is about planting a tree today so you can enjoy the shade for years and years to come. The most well-known of these is, of course, buy and hold. The idea couldn't be simpler. Find a fantastic, solid company, buy its stock, and then, well, you just hold on. You're betting that the company's long-term value will shine through, ignoring all the day-to-day noise. Warren Buffett? He is the absolute master of this. He buys great businesses and holds them for decades.
But you have to know that this strategy can have 2 very different outcomes. Back in the roaring bull market of the 90s, buy and hold felt like a cheat code for getting rich. But then, when the tech bubble burst in 2000, anyone holding on to those high-flying, overpriced tech stocks got absolutely crushed. It's a huge lesson. The what you buy is just as critical as the how.
And that brings us perfectly to value investing. Think of yourself as a professional bargain hunter. You're not chasing the hot new thing. You're digging through the clearance rack, looking for those amazing, high-quality brands that are just temporarily on sale. Value investors do deep, fundamental homework to find solid companies that everyone else has either forgotten about or unfairly beaten down.
Now, if you want to take emotion completely out of the picture, there's a great technique for that: dollar cost averaging. With this, you become a robot, in a good way. You just invest a fixed amount of money on a fixed schedule, like $100 every single month, no matter what the market is doing. When prices are low, your $100 buys more shares. When prices are high, it buys fewer. Over time, that discipline can really lower your average cost. Now, it's super important not to confuse this with something called averaging down. Dollar cost averaging is a disciplined plan you set up in advance. Averaging down is totally reactive. It's when you throw more money at a stock because it's falling, just hoping it'll turn around. And believe me, that can be a really dangerous game to play.
Okay, let's stick with the bargain hunters for a bit. These folks don't just wait for a sale. They actively go out and search for stocks that have been completely pummeled, believing there's gold hidden in the rubble. Buy on the dip was pretty much the mantra of the 1990s. The logic seemed foolproof. The market always goes up over time, right? So any little drop is just a temporary discount. If you liked a stock at $50, you should absolutely love it at 40. So you buy more.
But here's the massive risk, and it can be summed up in just one number. After 2000, the tech-heavy Nasdaq index fell by 80%. Imagine that. For all those investors who kept buying the dip, that wasn't a dip, it was a cliff. A fall that big can take over a decade to climb back from.
And that leads us to an even more extreme version of this, bottom fishing. This is when you're looking for stocks that have been so completely crushed, they're sitting in the bargain basement. You're thinking, it can't possibly go any lower. The big problem? Oh, it can. A stock can stay in the basement for a very, very long time. And this quote right here is just a chilling, real-world example of that danger. People thought Enron was a steal at $15. Then, they thought it was the deal of a century at $1. But the real bottom, 6 cents, right before it went to zero. The ultimate risk when you're bottom fishing is that you might end up catching a falling knife.
So, the last strategy in this group is contrarian investing. Contrarians have a simple motto: buy when there's blood in the streets. They love what everyone else hates. When a really good company gets hit with some bad news and the headlines turn sour, that's when a contrarian gets interested. It takes a ton of guts and research to buy when everyone else is panic selling, but the bet is that true quality will always win out in the end.
Okay, let's do a complete 180. We're going to shift gears from patience and bargain hunting to something way more aggressive. These next strategies are all about finding out what's hot right now and riding that wave for as long as you possibly can.
First up, growth investing. Growth investors are on the hunt for the superstars, the companies whose earnings are growing at an explosive rate, just leaving the rest of the market in the dust. Now, a really popular twist on this is called GARP, which stands for growth at a reasonable price. It's kind of like a hybrid approach. You're still looking for those high flyers, but only if the price tag hasn't gone completely into orbit.
Momentum investing takes that idea and kicks it up a notch. With this strategy, you're actually not that concerned about the company's underlying value. Your focus is almost entirely on the stock price itself. The plan is brutally simple: buy high and sell even higher. This strategy really shines in big bull markets when there's a lot of excitement and money is just pouring in. But of course, there is a very famous critique of this whole approach, and this quote nails it. It's called the greater fool's theory. The idea is that you're only making money because you're betting that no matter how ridiculous the price you paid is, you'll be able to find some greater fool to come along and pay an even more absurd price. The music keeps playing until it suddenly stops.
So, what if you don't really want to subscribe to a single philosophy? What if you're more of a checklist person? Well, that brings us to a really unique system that actually blends different kinds of analysis into one disciplined, rules-based method. It's called CanSlim, and it was developed by the legendary investor William O'Neill. It's basically a 7-point inspection for finding winning stocks. So let's break it down. C and A stand for strong current and annual earnings growth. The company has to be firing on all cylinders right now. N is for something new, a new product, new leadership, or the stock hitting a new price high. You need a catalyst. S is for supply and demand. You want fewer shares available and lots of people wanting them. L means it has to be a leader in its industry, not a laggard. I stands for institutional sponsorship. You want the big, smart money funds buying in. And finally, M, which is maybe the most important, market direction. You should only be buying when the overall market is trending up. It's a fascinating system that really combines the best of both worlds.
Phew, we have covered a ton of ground, haven't we? From super patient, long-term holds to aggressive, fast-moving trend following. So, how on earth do you choose? Well, this is the final and honestly the most important part. We have to bring all of this back to you.
And that brings us to maybe the most honest truth in all of investing. There is no magic answer. There just isn't.
No single strategy works for every single person all the time. Finding what truly fits your personality, your financial goals, and how much risk you can stomach, that's a personal journey. And yeah, it's going to involve a lot of research, some real-world experience, and probably a little bit of trial and error.
So I want to leave you with this question to think about. Which of these personalities sounds the most like you? Are you the patient planner, happy to build wealth slowly and steadily over time? Are you the fearless bargain hunter, excited to sift through the wreckage looking for those hidden gems? Or are you the trend-riding surfer, always looking to catch the market's biggest waves? Really, knowing yourself is the first and most crucial step on your investing path. Thanks for joining this explainer.
Have you ever seen those movies where traders are making millions in a matter of seconds? Well, today, we're going to pull back the curtain on that super fast-paced, high-stakes world of short-term trading. We're talking about strategies designed to make money not over years, but in minutes or even seconds. Let's dive right in and see how it all works. So, yeah, the idea of making money that fast sounds amazing, right? But here's the thing. It's way more complicated and, honestly, way more dangerous than it looks. How are these traders actually trying to pull this off? And what's the catch? Believe me, there's always a catch. That's exactly what we're here to figure out. So, here's our game plan. First, we'll get into the mindset, the need for speed. Then, we'll talk about trying to time the market's pulse. After that, we'll look at a wild strategy, betting against stocks. We'll also cover modern tools like ETFs, and then we'll enter the high-stakes options game. Finally, we'll wrap up by sorting out the news from the noise. Okay, let's kick things off with the absolute foundation. Before we get into any of the fancy strategies, you gotta understand the core philosophy that drives every single one of these traders. It all starts here. You see, this isn't your classic long-term investing, where you buy a great company and hold it for like 10 years. No way. These traders are living in the now. They're looking at volatile stocks, the ones that jump around a lot, and using what's called technical analysis. Basically, they're like detectives, scouring price charts and data patterns for clues about where the stock is headed in the next few minutes or hours. It's all about speed.
All right, now let's get into our first set of strategies. And these are all about one thing, the clock. For these traders, it's not just what you trade, it's when you trade that makes all the difference.
And here's the most famous one of them all, day trading. This is the absolute extreme. We're talking about buying a stock and maybe selling it 30 seconds later. The golden rule for a day trader: never hold a position overnight. By the time that closing bell rings, they've sold everything and are sitting on pure cash. Their entire workday is the 6.5 hours the market is open. Now, day trading had this huge moment back in the late 90s, right? Everyone thought they could quit their job and get rich from their bedroom. But let's get real for a second. The reality is absolutely brutal. You need insane discipline, a ton of money to start with, expert-level skill, and the patience of a saint to just stare at a screen all day. The hard truth? Almost nobody makes money doing this consistently. And if you thought day trading sounded hard, just you wait. Market timing is like playing the game on nightmare mode. This isn't just about guessing one stock's next move. Oh no. This is about trying to predict where the entire stock market is going, and then moving all your money into the right place before it happens. You're basically trying to outsmart millions of people and supercomputers. Good luck with that. This quote just nails it, doesn't it? It perfectly captures why this is so impossible. It's not one prediction you have to get right, it's two. You have to be a genius and know the exact right moment to buy, and then you have to be a genius again and know the exact right moment to sell. Getting one right is like catching lightning in a bottle. Getting both right over and over, that's why it's pretty much a myth. Okay, time to flip the script. So far, we've talked about betting on a stock going up. But what if you think a company's stock is about to tank? Well, there's a strategy for that, and it's called shorting. So here's how it works. It's kind of mind-bending. You see a stock that's shot up in price, and you think, no way, that's coming down. So you borrow shares of that stock from your broker and immediately sell them at that high price. Then you wait. If you're right and the price crashes, you buy the shares back at the new cheap price, return them to your broker, and you keep the difference. The catch? If you're wrong and the stock keeps going up, well, your losses are theoretically infinite. That's a scary thought. The world of finance never stands still, and traders are always getting new toys to play with. One of the biggest game changers in recent history has been the exchange-traded fund, or what everyone just calls an ETF. So, what the heck is an ETF? Think of it as the best of both worlds. On one hand, it's like a mutual fund. It holds a whole basket of different stocks, maybe all the tech companies, or all the biggest companies in the S&P 500. But on the other hand, it trades on the stock market just like a single stock. You can buy and sell it all day long. It's a game changer. And this right here shows you why they're so popular. If you wanted to own, say, 100 different tech stocks, you'd have to make 100 different trades. That's a huge pain, and it can be expensive. With an ETF, you make one single trade, and boom, you're instantly diversified across all 100 of those companies. It's simple, it's efficient, and it's powerful. A perfect example is the famous Qs, ticker symbol QQQ. This one ETF lets you trade the 100 biggest tech-heavy companies on the Nasdaq all at once. For traders, this thing is a dream. It's super liquid, meaning it's incredibly easy to get in and out of your trades fast. And get this, there's no uptick rule, which is an old rule that sometimes makes it hard to short a stock. So with the Qs, you have total freedom to bet for or against the biggest names in tech. Okay, everybody take a deep breath. We are now entering the most complex, the most powerful, and frankly, the most dangerous part of our tour. Welcome to the world of options. This can get confusing, but stick with me.
So what is an option? At its heart, it's just a contract. And this contract gives you the right to do something. But, and this is the most important part, not the obligation. It gives you the right to buy or sell a stock at a price you both agree on today by a certain date in the future. That little difference between a right and an obligation is everything.
Now, it basically boils down to two flavors. You've got call options and put options. A call gives you the right to buy a stock. So you'd buy a call if you're super bullish and think a stock is about to go to the moon. A put gives you the right to sell a stock. You'd buy a put if you're bearish and think a stock's price is about to fall off a cliff. Simple as that. So why bother with these complicated things? One word, leverage. Just look at this. To buy 500 shares of a $20 stock, you'd need to fork over 10 grand. But you could buy call options that control the exact same 500 shares for just $1,000. You get to control a huge amount of stock for a tiny fraction of the cost. It's an incredible amount of power. And with great power comes, well, you know. And here it is, the reality check. After all that talk about power and leverage, you need to see this number. Studies have shown that a jaw-dropping 90%, 9 out of 10 of all options contracts expire completely worthless. That means the person who bought it loses 100% of their money. The odds are just massively, overwhelmingly stacked against you. Now, to be fair, not all options strategies are like buying a lottery ticket. There's a more conservative approach called writing covered calls. This is where, if you already own a stock, you can sell a call option to someone else. You get paid cash up front, which is great. The only risk is that if the stock price skyrockets, you'll be forced to sell your shares at the lower agreed upon price. So you're trading huge potential gains for immediate income. All right, let's bring it all home. We've talked about the strategies, the tools, the risks. Now let's talk about the final piece of the puzzle, information. How do traders use the news, and what's the ultimate reality of this whole high-speed game? You've probably heard this saying before, and it's so true. Trying to trade on the news is a fool's game. Why? Because the market is always a step ahead. By the time a company actually announces its amazing earnings, the big money pros have already priced that possibility in. That's why you'll often see a stock's price drop right after good news comes out. The party was already over before you even got the invitation. And that really brings us to the most important thing to remember from all of this. To win at this high-speed game, especially with something like options, you basically have to be perfect. It is not enough to be right that a stock will go up. You also have to be right about when it will go up. If you're wrong about the direction or you're wrong about the timing, the result is almost always the same. You lose every single penny you put in. And that's a powerful lesson about the true price of chasing speed.
Okay, so you're looking at the stock market. It's this huge ocean of companies, thousands of them, all asking for your investment. So how in the world do you pick one? How do you separate a potential winner from a total dud? Well, today we're going to break down one of the most powerful ways to do exactly that. It's called fundamental analysis.
When you get right down to it, there are basically two main paths people take to pick stocks. On one side, you have what's called technical analysis. Now, these folks live and die by the stock chart. They're looking at price movements, patterns, all those squiggly lines, trying to predict where the price is going to go next. But on the other path, and this is what we're focused on, is fundamental analysis. This approach, it kind of ignores the chart. It's all about studying the company itself, the actual business behind the stock ticker.
So here's our playbook for today. We're going to cover the two paths, talk about thinking like an owner, starting with the big picture, then zooming in on the company, decoding its financial story, and finally, remembering that this whole thing is more of an art than a science.
So why are we focusing so much on fundamental analysis? Simple. Because it's the method that the absolute best in the business have trusted for decades to find real, lasting value. I mean, we are talking about the titans of investing here. People like Warren Buffett, Peter Lynch, Robert Rodriguez, William Miller. These guys built their legendary careers not by guessing which way a chart was going to move, but by doing the deep dive detective work to really understand the businesses they were buying into.
And that brings us to the single most important idea in all of fundamental analysis. It's a mindset shift, but it's one that completely changes the way you look at investing forever.
You know, when you're online and you click buy on a stock, it feels a little abstract, right? Like you're just trading a digital symbol or a piece of paper. But that's not what's really happening. Not at all.
What you're actually doing is buying a tiny slice of a real-world, living, breathing company. You become a part owner. And that, right there, is the whole point. Fundamental analysis is just the process of investigating that corporation to decide if it's a business you'd actually be proud to own.
Okay, so if you're going to be a business owner, a real investigator, where do you start? Well, maybe counterintuitively, you don't start with the company. You start way, way bigger. You got to pull out the wide-angle lens first.
So where does that investigation start? It begins with the industry the company operates in. Because think about it. To find a great company, it really helps to first find a great industry.
It really boils down to two steps to get started. First, you analyze the industry itself. Is this industry growing? Is it dying? What's its future look like? And then, once you find an industry you like, step two is to figure out who the leaders are, the top dogs, the companies that are really dominating that space.
And listen, this doesn't have to be some super complex academic thing. The legendary investor Peter Lynch famously said he got some of his best stock ideas by just paying attention to the world around him. He'd see which stores his kids were dragging him into at the mall, which ones were always packed. A busy store is a clue, right? It's not a reason to buy the stock on the spot, but it's an awesome breadcrumb to start following.
All right, so you've found a good industry, and you've spotted a couple of the leading companies. Now it's time to put that wide-angle lens away and grab the microscope. We're zooming in on the company itself, and we're going to start with the people in charge.
So how do you figure out if the company is in good hands? Well, you can get clues from the inside in a couple of ways. The big-time professional investors, they'll actually try to talk to the CEO and other managers. But for the rest of us, there's another really powerful clue. Watch what the insiders are doing with their own money.
Paying attention to when insiders buy or sell their own company stock can be huge. I mean, who knows more about a company's prospects than the people running it? But, and this is a big but, it's not a perfect signal. The reports can be delayed, sometimes by months, and an insider might sell for a million personal reasons, like buying a house, that have zero to do with the company's health. It's a clue, for sure. But remember Enron and WorldCom? Executives were dumping stock like crazy before the collapse, but the public didn't find out until it was way too late.
Okay, so we've looked at the big picture, we've looked at the people, now it's time for the main event, digging into the hard evidence. We need to decode the story that the company's numbers are telling us.
And the most important document for this is called the balance sheet. Now I know that sounds super formal and maybe a little intimidating, but trust me, the concept is really simple. Think of it like a financial snapshot, a picture of the company's health on one specific day. All it does is list what a company owns, those are its assets, and what it owes, those are its liabilities. That's it.
So here's a really simple example. You see the assets, you see the liabilities, and then you see what's left over. That's called the stockholder's equity. The whole magic formula is just assets minus liabilities equals equity. That equity number tells you what would be left for the owners if the company sold everything it owns and paid off every single debt. Ideally, you want to see that number growing. And here's a quick check. Compare the total liabilities to that equity. If a company has way more debt than equity, it could be a pretty risky bet.
But here's the scary part. A balance sheet is supposed to be cold, hard fact. But sometimes the truth can be hidden. Companies like Enron and WorldCom were masters of deception. They used all sorts of accounting tricks to hide their debt and make their business look way healthier than it actually was.
And this all leads to maybe the best piece of advice ever on this topic, from the master himself, Warren Buffett. His rule was basically, if you can't understand the business and its financials, don't invest. The lesson for us is simple. If you read a balance sheet and you're just totally confused, that confusion itself is your red flag. It's time to just walk away and invest your money somewhere else.
You'll find the balance sheet inside a company's annual report. Yeah, these things can be long and full of boring corporate speak, but they are also gold mines. And here's a pro tip. Always read the footnotes. That's where companies have to disclose the juicy stuff like major lawsuits or weird accounting changes. It's often where you find the red flags the big numbers try to hide.
So, after all this digging, after all this detective work, what's the big takeaway? Well, it's that you have to remember that fundamental analysis is not a crystal ball.
Look, at the end of the day, fundamental analysis is an incredibly powerful tool. It gives you a framework to find good businesses and figure out if they're worth owning. It's about stacking the odds in your favor. But, and you have to hear this, it does not and it cannot guarantee you will make money. It's about making smart, informed decisions, not about finding some magic formula for getting rich.
So, I want to leave you with one final question to think about. After you've looked at all the charts, after you've read all the reports and crunched all the numbers, what's the one thing you absolutely have to understand? It's the business itself. Do you get it? Do you believe in what they do? Is this a company that you would genuinely be proud to own a piece of? That is the ultimate question that this whole process helps you answer.
Welcome to The Explainer. Today, we're going to crack open the investor's toolbox. We'll break down all the tools and tactics of something called fundamental analysis, all to figure out what a company is really worth, underneath all that day-to-day market chaos. I mean, that's the million-dollar question, right? Before you put your own hard-earned money on the line, you've got to have a way to cut through all the noise, all the hype, and just see what's really going on with a company's health and its value. And that is exactly what we're going to dig into today. So, here's our game plan. First up, what even is fundamental analysis? Then we're going to put on our detective hats and decode the income statement. After that, we'll talk about the power of something called EPS, figure out how to put a price on a stock, look at some of the dangers and hype, and wrap it all up with a big takeaway. Okay, let's jump right in. Section 1. What is fundamental analysis? What does that term even mean? When you boil it all down, the goal is pretty simple. We're just trying to answer two basic questions. 1, is this company actually healthy, financially speaking? And 2, if it is the current price of its stock fair? It's all about figuring out a company's real worth, its intrinsic value, not just what the hype of the market says it's worth today. And I gotta say, I love thinking about it this way. You really do have to be a stock detective. It's so important because the numbers you see on a report, they're just the first clue. You've got to dig deeper, ask the tough questions, and connect the dots to see what's really going on. Because believe me, numbers can be misleading. All right, so let's grab our first piece of evidence. This is the income statement. Think of it as the company's financial story. It tells you exactly how they make their money, and more importantly, how much of it they actually get to keep. Okay, so take a look at this. It's a sample income statement for a company. We'll call it Florida Star. You can see the data for 3 years. The very first thing your eyes should go to is that top line, total sales revenue. That's just all the money coming in the door. And what you want to see is growth. For these guys, it's going up from about 4 million to over 7 million. That's a good sign, a really good start. Okay, but it costs money to make money, right? So the next line down is total operating expenses. This is everything they had to spend to get those sales. We're talking salaries, rent, marketing, the whole shebang. So you take the money that came in, subtract the money that went out, and what's left over? Well, that's the famous bottom line. It's the net income, the pure profit. And look at that. Just like their revenue, their profit is climbing every year. That's exactly the kind of positive clue we're looking for. All right, so the company's making a profit. That's great, but so what? What does that big profit number actually mean for you if you're thinking about buying just a single share of their stock? Well, that's where our next clue comes in, earnings per share, or EPS. And listen, this is a huge one. EPS is one of the most important numbers you can look at. It takes that huge net income number and slices it up, assigning a piece of the profit to every single share out there. So it literally tells you how much of the company's profit belongs to your one share. And just like with revenue and profit, if you see that EPS number climbing year after year, that is a fantastic sign of a healthy company. But here's where it gets a little crazy. Wall Street turns this whole EPS thing into a high-stakes guessing game. You have all these analysts making predictions, estimates of what a company's EPS is going to be. And the pressure on CEOs to hit those numbers is just intense. If they beat the estimate, the stock usually pops. But if they miss it, even by a single penny, the stock can get hammered. And that pressure, well, it can make people do some pretty creative accounting.
Okay, so we've got a handle on the company's earnings. Now it's time to answer that second big question. Is the stock price fair? Is it a good deal? And to figure that out, we're going to use a few tools called valuation ratios.
First up is the granddaddy of them all, the price-to-earnings ratio, or PE ratio. This is a super quick way to see what the market thinks about a company. It basically tells you how many dollars investors are willing to pay today for just $1 of that company's earnings. So if the PE is 20, it means people are paying $20 for $1 of profit. Now, a high PE could mean everyone expects huge growth, but a low PE might mean you found a bargain, or it could be a warning sign.
And this PE ratio really splits investors into two main camps. First, you've got your value investors. Think Warren Buffett. These are the bargain hunters. They're looking for great companies that the market has overlooked, so they have a low PE. Then you've got your growth investors. These folks are totally fine paying a high PE because they're betting on massive growth in the future that will make today's price look cheap. And look, neither one is right. They're just two totally different ways to play the game.
And man, this is a perfect cautionary tale. Back in the dot-com bubble, you had people saying things like, oh, PE ratios don't matter anymore. They were throwing money at companies that had no earnings at all. And then, boom, Priceline stock completely cratered. It's just a brutal reminder that while hype can send a stock to the moon for a little while, sooner or later, the fundamentals, the actual value, tend to matter. So to try and bridge that gap between value and growth investing, people came up with something called the PEG ratio. It asks a smarter question. Okay, the PE is high, but is the growth high enough to justify it? It's a great tool, but even that can't always catch a company that's, let's say, being less than honest with its earnings, which is why we have other tools. And to show you why, just look at this number.
200. That was the price-to-sales ratio of a huge, well-known American company, right before it went up in smoke.
Yup, Enron. See, the reason the price-to-sales ratio is so powerful is because it's really, really hard to fake your sales. You can play all sorts of games with your earnings, but the top-line revenue, that's tougher to mess with. And this number was screaming a warning. It meant that people were paying $200 for every $1 of stuff Enron actually sold. That's not just a red flag. That's a 5-alarm fire. So you see the big takeaway here, right? No single number, no single tool can tell you everything. They're all just pieces of the puzzle. You have to use them together, and you have to step back and look at the company's overall health and keep an eye out for the dangers.
Speaking of health, another great metric is called return on equity, or ROE. This one is all about management. It basically asks, how good is the leadership team at taking the money investors gave them and turning it into more money? Think of it like a report card for the CEO. If you see a company with a high and rising ROE, that's a sign that the people in charge know what they're doing.
But look, we have to be honest with ourselves. As great as these tools are, they aren't magic. They have problems. For one, they count on the company giving you honest numbers, which, as we've seen, doesn't always happen. They're also based on guessing the future, and nobody's crystal ball is perfect. And sometimes the market just goes nuts, and all the fundamentals in the world don't seem to matter for a while.
So after going through all these ratios and warnings, it's easy to feel like this is all way too complicated. So let's just boil it all down to one simple, powerful idea, and it comes from the best in the business. And here it is. This is the core of it all. Warren Buffett, probably the greatest investor ever, didn't build his fortune with some super secret complex formula. He did it with common sense. He has one simple rule. Only invest in a business that is simple and that you can actually understand. I mean, if you can't explain to a friend what a company actually does to make money, then you really have no business owning its stock. It's that simple.
So in the end, that's the real question you have to ask yourself. You can learn to use all these analyst tools, no problem. But do you have the investor's patience? Because using this stuff well isn't just about crunching numbers. It's about having the right mindset, the discipline, and the patience to stick with your decisions. Thanks so much for joining me for this explainer.
Have you ever looked at a stock chart and just seen, well, a bunch of confusing squiggly lines? You are definitely not alone. But what if I told you those lines are actually telling a story? A pretty dramatic story, really, all about fear and greed and the psychology of the entire market. That's the whole idea behind what's called technical analysis. It's a way of reading the market's mood, not by digging through financial reports, but by looking at the pictures the prices themselves are painting. And today, we're going to learn how to read those pictures. You know, Winston Churchill wasn't talking about stocks here, but he absolutely nailed the philosophy of technical analysis. The core belief is that history tends to repeat itself. By studying how a stock's price has acted in the past, how it's reacted at certain price points and formed specific shapes, we can make a really educated guess about what it might do next. It's all about looking for clues in the past to navigate the future.
All right, so this brings us to the first big idea. It's really about choosing your tools. When you're trying to figure out a stock, are you the type who wants to dig into a spreadsheet, or would you rather just look at a picture?
So the world of stock analysis is kind of split into two big camps. On one side, you have fundamental analysis. You can think of these folks as the detectives. They are poring over a company's health records, earnings, debt, and who the managers are, all to figure out what the company is actually worth. But then you have the other side, technical analysis. And technicians, they argue that all that detective work is already baked into the stock's current price. So they say, why study the company? Instead, they study the price action itself, looking for patterns that might just reveal the market's true feelings.
This metaphor really gets to the heart of it, doesn't it? I mean, a surgeon would never operate without looking at an X-ray, right? Well, for a technical analyst, the stock chart is the X-ray. It's their main diagnostic tool to see the health of a stock's price. It helps them visualize the constant battle between buyers and sellers and gives them clues about who might be winning. The whole point is to try and remove emotion and just analyze the raw evidence right there on the screen.
Okay, so if the chart is our X-ray, we've got to learn how to read it. Let's start with the absolute basics, kind of like the alphabet of the market's visual language.
First up is the line chart. This is the one you've probably seen a million times on the nightly news. It's super simple and clean. All it does is connect the closing prices from day to day to give you a quick, big picture view of a stock's journey. It's great for getting the general trend at a glance, but it hides all the drama that happened during the day. It doesn't tell you how high the stock flew or how low it plunged before it finally settled at that closing price.
Now for a little more of that drama, we can move to a bar chart. See? Now we're getting a lot more information. Each one of these little vertical bars tells a much richer story. The very top of the bar, that's the highest price the stock hit that day. The bottom is the lowest. And then you have these two little horizontal ticks. The little tick on the left is the price where it opened, and the tick on the right is where it closed. So with just one of these bars, you suddenly know the entire price range for the whole day.
And that brings us to the favorite of most modern traders, the candlestick chart. Now it shows the exact same 4 data points as the bar chart, open, high, low, and close. But it displays them in a way that's way more intuitive. You see that thick part? That's called the body. And by giving that space between the open and close a body, it gives you an instant visual about the power struggle between buyers and sellers on any given day.
So, how do you actually read the candle's body? It's really simple. If the body is clear, or sometimes green, it just means the price closed higher than where it started. The buyers, or the bulls, were in control. It was an up day. If the body is solid, or maybe red, it means the price closed lower than where it opened. The sellers, the bears, won that battle. It was a down day. So in a single glance, you can feel the momentum of the entire trading day.
Okay, now that we kind of get the basic chart types, let's zoom out a bit. What's the bigger story these charts are telling us over time? Well, it all comes down to one really important word: trend.
This is one of the oldest, most repeated sayings in all of technical analysis, and for very good reason. The entire goal is to figure out the main direction a stock is moving and just ride that wave for as long as you possibly can. But of course, that part in the parentheses is just as important. No trend lasts forever, and a huge part of the skill is recognizing when that trend is about to turn around.
At the end of the day, a stock can only really be moving in one of 3 directions. You've got an uptrend, which is what buyers absolutely love to see, and that's just a series of higher highs and higher lows. Then you have the downtrend, which is the exact opposite, a series of lower highs and lower lows. And finally, there's the sideways trend, where the stock is just bouncing around in a range. Traders usually call this consolidation.
Here's a classic picture of an uptrend. Notice it's not just a straight line going up. There are dips along the way, but each peak is higher than the last one, and each valley or dip is also higher than the last. This is the momentum that traders are looking to join. The strategy here isn't always buy low, sell high. Sometimes it's buy high and sell even higher.
And on the flip side, this is what a downtrend looks like. Trying to be a hero and buy a stock that is clearly falling like this, well, it can be devastating. During the dot-com bust back in 2000, so many investors just kept buying their favorite tech stocks as they fell, thinking, oh, it'll bounce back. But the downtrend was just so powerful and relentless, and it wiped out countless accounts. Ignoring the trend is one of the most expensive mistakes an investor can make.
Now let's build on that. If trends are the overall plot of the story, then inside that plot are these key moments of conflict, these really dramatic battles between the buyers and the sellers. And these battles create recognizable shapes and patterns on the chart that can give us clues about what might happen next.
So, the two most important ideas here are support and resistance. Think of it like a constant tug of war. Support is a price level. It's like a floor, where buyers consistently show up in force. Demand just overwhelms supply and they stop the price from falling any lower. Resistance is the exact opposite. It's a price ceiling where sellers take control, supply overwhelms demand, and they stop the price from rising any higher.
Let's look at a real example so you can see what I mean. Here's a chart of Johnson & Johnson. You can see the price came down to around $56.50. Not once, not twice, but 3 different times, and each time it bounced right back up. That price level was acting as a really strong support, a floor held up by all the buyers. But look what happened at the end. It finally crashed right through that floor. For a technician, that is a huge red flag. It means the buyers have lost that battle.
And here's the opposite scenario with Boeing. The stock rallied up to the $37 level, but it just could not break through. It's like it hit a brick wall. It hit that ceiling and fell back. It tried again, and it fell back again. That $37 level was a major resistance zone where sellers were just consistently taking their profits and overwhelming any new buyers coming in.
Now, when these battles at support and resistance play out over time, they start to form these recognizable patterns. One of the most famous is the head and shoulders. You see a peak, that's the left shoulder, then a higher peak, which is the head, and then a final, lower peak, the right shoulder. This pattern tells a story. The buyers made one last powerful push to a new high, but they failed. Their next attempt to rally was weaker, which shows they're losing momentum. It's a classic signal that an uptrend is just exhausted. And its mirror image, the reverse head and shoulders, it signals the exact opposite, that a bottom might be in.
Another classic pattern of patterns we'll see all the time are the double top and the double bottom. A double top, which looks kind of like the letter M, forms when a stock hits a resistance level twice and just can't break through. It's a very strong signal that the buyers are just plain tired. And on the flip side, the double bottom, which looks like a W, forms when a stock tests a support level twice and holds strong. It suggests the sellers have run out of gas and the buyers are about to take over.
Okay, so we've covered trends, we've covered levels, and we've covered patterns. Now, let's put it all together. Let's become market historians for a second and see how these very tools painted a massive warning sign right before one of the biggest crashes in modern history.
This right here, this is the Nasdaq chart from the dot-com bubble. And if you look closely at the peak in early 2000, what do you see? There it is, a massive, undeniable head and shoulders pattern signaling the top of a historic bull market. The entire psychology of the market was shifting. Then, after the pattern completed and the price broke down, the market tried to rally again, but it failed at a lower high, confirming the sellers were now completely in control. For technicians watching this, these weren't just squiggles. These were giant billboards screaming that the party was over, and a brutal downtrend was about to begin. Now look, it's really important to be balanced here. Critics of technical analysis will tell you this is all just hindsight, like reading shapes in the clouds or fortunes in tea leaves. And they argue, correctly, that past performance is absolutely no guarantee of future results. They'll also point out that this is as much an art as it is a science. There's a lot of subjective interpretation involved, and not every pattern plays out the way you think it will. But ultimately, that's what technical analysis is really trying to do. It's a tool for trying to visualize market psychology, the collective hope, fear, and greed of millions of investors all boiled down into one picture. The patterns are just reflections of predictable human behavior. Which, well, it leaves us with one final question to think about. When you invest, are you acting as part of that emotional crowd, or are you stepping back and trying to watch what the crowd is doing?
All right, let's dive in. Today, we're going to crack open the toolkit of the technical analyst. We're talking about the specific instruments traders use to read the story of a stock chart and figure out exactly when to hit that buy or sell button. And you know what the best part is? Everything we're about to cover, it's all right there on the chart itself. So here's the game plan. First, we'll cover the basics of just decoding a chart. Then we're going to build up from there, layer by layer. We'll get into the power of volume, learn how to track trends, gauge the pressure in the market, and finally get a handle on a stock's volatility. Let's get to it. You know, when you first look at a stock chart, it can honestly seem like a totally foreign language. But don't worry, the whole point today is to give you the key to start translating it. With a little bit of practice, believe me, those lines and squiggles will start telling you a very, very clear story. So be honest, have you ever pulled up a stock chart and just felt like you were staring at a random, meaningless line going up and down? What if I told you that by the time we're done here, you'll have the basic tools to actually start reading that line and understanding the story it's telling? Okay, let's kick things off with our most foundational tool, volume. It's one of the most important indicators on a chart, but so many people underestimate it. I want you to think of it like this. The stock's price tells you how fast the car is going, but the volume tells you how much fuel is in the tank. It shows you the real conviction behind every single move. So what is volume really? It's just the total number of shares that are bought and sold during a certain time, like a single day. When you hear pro traders talk about a liquid market, all they really mean is a market with super high volume. And they love that because it means they can get in and out of their trades easily without accidentally pushing the price around. And this is why it's so crucial. Volume helps you tell the difference between just random market noise and a real, meaningful move that's backed by serious money. When you see a stock's price shoot up on really high volume, you can be a lot more confident that there's some genuine strength behind that rally. It's the first step for any technical analyst. Okay, so now that we understand the force behind a move, let's talk about how to figure out its direction. And for that, we're going to turn to one of the simplest yet most powerful tools in the entire kit, moving averages, or MAs for short. These things are absolutely essential for spotting a stock's trend. A moving average is pretty much exactly what it sounds like. It just takes the average price of a stock over a specific period, let's say 50 days, or maybe 200 days, and it plots it as a single, smooth line on the chart. What this does is it filters out all that choppy day-to-day noise, and it gives you a much clearer picture of the underlying trend. Traders often treat these lines like moving floors and ceilings for the stock price. Let's take a look at it in action right here on a chart of Caterpillar. Now, for most of this time period, just notice how the stock price, that's the jagged line, really struggles to get above those two smoother moving average lines. Okay, now look at the end of August. See that? The price tries to rally, but it bonks its head right on that 50-day moving average and gets rejected. It's acting like a ceiling. But then, look what happens in late October. The price doesn't just touch the line, it breaks through it, and it does it with authority. And if you look down at the volume bars, you can see volume is picking up. That right there is a classic bullish signal. So to boil it all down, when the price is trading above its moving average, that's generally a bullish sign. When it's below, well, that's bearish. The really big institutional investors, they keep a close eye on that long-term 200-day MA, while shorter-term traders might focus more on the 40 or 50-day to time their moves. Okay, so we can identify a trend. But how strong is that trend, really? I mean, is it just getting started or is it running out of gas? To answer that, we need tools that can measure the underlying pressure, the money flow, the momentum. And we're going to look at two really powerful ones, on-balance volume and the relative strength index. This first one, on-balance volume, or OBV, is a real gem. It's one of the most important yet underutilized indicators out there. Basically, it's a running total of volume that shows you if money is flowing into a stock or out of it. It's amazing for confirming a price move, but more importantly, it can warn you of a potential reversal when it starts to disagree with what the price is doing. Let's go back to our Caterpillar chart. The price is on top, and now we've added the on-balance volume line at the bottom. Okay, watch this. As the price initially starts to rally, the OBV line rises right along with it. Perfect. That's confirmation. The move is legit. But look really closely at what happens in early December. The price is still way up there. It's trying to hang on. But the OBV line, it's already rolled over and started heading down. That is a huge warning sign. It's called a divergence, and it was basically whispering to us that the smart money was quietly heading for the exits. So the main takeaway here is pretty simple. If the OBV line is rising, the buyers are in control. If it's falling, the sellers are winning. But the real magic of this tool is spotting a divergence. When you see a stock's price hit a new high, but the OBV line doesn't, that's a massive red flag. It's a sign that the rally might be built on a pretty weak foundation. All right, next up is the RSI, the Relative Strength Indicator. This is what's known as an oscillator, and it's designed to help you figure out when a stock might be overbought or oversold. It does this by measuring how the stock is performing against itself over a recent period, and it plots it on a simple scale from 0 to 100. Now hang on, because we need to be really careful with the terminology here. The tool itself is called the Relative Strength Index, or RSI, and what it measures is a stock's strength relative to its own recent prices. This is totally different from the broader concept of relative strength, which is when you compare a stock's performance to the whole market, like the S&P 500. For our purposes with this RSI tool, we are only looking at whether the stock is overbought or oversold compared to itself. Okay, let's head back to the Caterpillar chart one more time. Price is up top, and the RSI is that squiggly line at the bottom, bouncing between 0 and 100. Now find the month of August on the chart. You see how that RSI line takes a nosedive way down below that 30 level? Now look over at October. It does the exact same thing again. In both of those cases, the RSI was basically screaming that the stock was oversold. And just look at what happened to the price right after each time. A huge, powerful rally. So, the standard levels you're going to want to watch are 70 and 30. If you see a reading above 70, it suggests a stock might be getting a little too hot. It could be overbought and due for a pullback. A reading below 30 suggests the opposite. It might be oversold and ready for a bounce. But please remember, no single indicator is a magic bullet. It's always best to use RSI with other tools to confirm what you think you're seeing. All right, our final tool for today adds a whole new dimension to our analysis: volatility. You know, markets are always moving from periods of calm to periods of chaos, and back again. Bollinger Bands are designed to help us see and even capitalize on those shifts. Like the RSI, they can help signal when a stock is overextended, but they do it in a really unique way. So, Bollinger Bands are pretty simple. They're made of 3 lines. You've got an upper band and a lower band, with a moving average running right down the middle. The real secret sauce here is that those outer bands get wider when volatility picks up, and they get tighter when things calm down, creating this dynamic channel around the price. And you can see this happening right here on the chart. First, look for those moments when the upper and lower bands get super narrow, almost like they're squeezing the price. Traders call this a Bollinger Band squeeze, and it often acts like a coiled spring, warning you that a big, explosive move could be right around the corner. The other thing to watch for is when the price actually moves outside one of the bands. That's an extreme move, and it often suggests that the trend is overextended, and a snapback toward that middle line is pretty likely. While we have covered a whole lot of powerful tools today, from volume and moving averages to all these oscillators, but I want to be clear, the ultimate goal of using any of these isn't to create more confusion, it's to achieve clarity. This quote just hits the nail on the head. It's such a common trap for new traders. You get excited and you want to load up your chart with every indicator you can find, but all that does is lead to analysis paralysis. You have so much conflicting information that you just freeze up, unable to make a trade. So if there's one key takeaway from all of this, it's this. Find a few of these tools that you like and master them. Learn how they work together. That is so much more powerful than having a cluttered chart that you don't really understand. So you've seen the Technician's Toolkit. You've gotten a peek under the hood. But it really leaves us with one final big question to think about. Is all of this some kind of predictive science that can tell you the future? Or is it more of a responsive art form, helping you react intelligently to the market as it unfolds? Something to chew on as you continue your journey.
You know, when we talk about the stock market, our minds usually jump straight to the numbers, right? We're thinking earnings reports, price charts, all that economic data. But what if I told you that one of the biggest forces moving the market isn't in a spreadsheet at all? What if it's in the collective mind, the mood of millions of investors? Well, today, that's exactly what we're diving into, the psychology of stocks and sentiment analysis.
To get us started, let's look at a classic quote that just nails this idea. It's 1996, the dot-com boom is in full swing, and the Fed chairman Alan Greenspan comes out with these 2 famous words: irrational exuberance. Now here's the crazy part. He said this a full 4 years before that bubble actually burst. It's a perfect example of how the market's mood can get so extreme, so optimistic, and stay that way for a long, long time before reality finally decides to crash the party.
So what is this stuff really? Well, it's called sentiment analysis. It's basically the art of studying all the psychological clues from what Wall Street calls the herd, the investing crowds, to try and figure out where the market's headed next. And here's the kicker. More often than not, once you figure out which way the herd is stampeding, the smartest thing you can do is run in the exact opposite direction. All right, so here's the game plan. First, we'll look at the market's mood ring to get a feel for sentiment itself. Then we'll dive into the famous fear gauge. After that, we'll talk about how to read the headlines for hidden clues. Then we'll get into the most dramatic part of any market cycle, when everyone sells at once. And finally, we'll wrap up with a really important warning that could save you a lot of grief.
Okay, so you've probably heard of fundamental analysis, which is all about a company's financial health, and technical analysis, which is about studying price charts. Well, think of sentiment analysis as the third pillar. It's way less about hard numbers and way more about, reading the room. And believe me, it is every bit as important.
At the very heart of all this is a big tug of war. On one side, you've got the herd. The herd feels safe moving together. They get excited and pile in when prices are soaring and everyone's optimistic. And they panic and sell everything when prices are dropping and fear is in the air. But then, you have the contrarian. A contrarian looks at what the herd is doing and sees a signal. When the herd is extremely optimistic, that's a warning sign. And when the herd is terrified, well, that's an opportunity.
So let's get practical. How do you actually measure something as fuzzy and emotional as fear? Well, it turns out there's a tool for that. One of the most popular is the market's official fear gauge, an index called the VIX.
So VIX is short for Volatility Index, and to put it simply, it measures how much turbulence investors think is coming. See, when people get nervous, they buy what's basically insurance on their stocks to protect themselves. The VIX just tracks the price of that insurance. So if the VIX is high, it means anxiety is high.
And this chart right here really tells the story. Take a look at those massive spikes. Right after September 11, 2001, you can see the VIX shot up to 50 as pure panic took over. But then, look back at early 2000, right at the peak of the dot-com bubble. The VIX dropped down to 18. That's a sign of extreme confidence, maybe even overconfidence. It's simple. A high VIX means high fear, a low VIX means low fear.
Okay, now here's where it gets a little weird, a little counterintuitive. A high VIX means option traders are scared and are betting the market will crash. A low VIX means they're feeling greedy and betting it'll rally. So why on earth would you do the opposite? It all comes down to a really brutal statistic. An estimated 90% of option traders lose money. So the theory goes, if the overwhelming majority of them are betting on one thing, there's a pretty good chance the exact opposite is about to happen.
So you can pretty much break this down into a simple guide. Historically, if the VIX goes above 30, that signals extreme fear in the market, and for a contrarian, that could be a potential buying opportunity. If it drops below 20, that suggests a lot of greed and complacency out there, maybe a time to sell or at least be careful. Anything in between 20 and 30 is generally considered the normal zone.
And to make this super easy to remember, there's a great old saying on Wall Street that just sums it all up perfectly. When the VIX is low, it's time to go. When the VIX is high, it's time to buy. That's the contrarian mantra in a nutshell.
But hey, the VIX isn't the only game in town. Let's keep building on this idea and look at some other places you can spot clues about the market's mood, like, say, on the evening news or on the cover of your favorite magazine.
Seriously, think about it. When everyone, your neighbor, your barber, the evening news, is gushing about a new economy and how the stock market is unstoppable, it means that optimism has hit a fever pitch. By the time an investment idea is popular enough to make the cover of a major magazine, you can bet the early investors have already made their money and are looking for the exit. That widespread media euphoria, it's often a massive flashing sign that a trend is getting close to its end.
Here's another fantastic example. The financial publication Barron's keeps track of a survey of investment newsletter writers. And again, the logic is totally contrarian. If more than 60% of these pros are bullish and screaming buy, it's actually considered a bearish sign for the market. And on the flip side, if more than 55% of them are bearish and doom and gloom, it's seen as a bullish sign. It just goes to show, when all the experts agree on something, it might be time to get a little skeptical.
And finally, we can just look at what regular investors are doing with their own cash, and we do that by looking at mutual fund redemptions. When people start pulling their money out of funds like crazy, it is a crystal clear sign of fear. This actually forces the fund managers to sell stocks to pay everyone back, which can push the market down even further.
But for a contrarian, this mass exodus can be a powerful bullish signal, because it often sets the stage for the market's most dramatic act, total surrender.
And that leads us to the ultimate, most extreme expression of market fear, a phenomenon with a pretty dramatic name: capitulation. This is the moment when the herd doesn't just get nervous and walk away. It stampedes for the exit all at once.
Capitulation is the point of maximum pain. It's that moment when investors just collectively give up all hope and sell everything they own, at any price, just to stop the bleeding. The theory is, after every single person who was going to sell has finally sold, well, there are no sellers left. The market hits rock bottom, and the only place left to go is up, as smart buyers with cash on the sidelines step in to scoop up stocks at a fire sale.
And the scale of this is just staggering. We are not talking about a little dip here. A true capitulation event can cause the market to fall by 10% or even more in a single day. It's a true market crash, born from pure, unfiltered panic.
We've seen this kind of thing happen a couple of times in the 20th century. After the Great Crash of 1929, the market took an unbelievable 25 years to get back to where it was. But then you have Black Monday in 1987. The market fell over 20% in one day, but it recovered in just a year and a half. This just shows that while capitulation is absolutely terrifying, it can also be a historic buying opportunity if you can keep your head while everyone else is losing theirs.
Now, this raw emotion, this extreme greed and this extreme fear of the herd is exactly what scammers love to prey on. So understanding market psychology isn't just about finding opportunities, it's also about protecting yourself. Let's quickly cover two very common scams that are designed to exploit these exact feelings. First up, you've got the classic pump and dump. Here's how it works. Insiders quietly buy up a ton of a cheap, obscure stock. Then comes the pump. They start spreading fake news and hype all over internet chat rooms and fake press releases, promising it's the next big thing. As unsuspecting buyers jump in, the price gets inflated. And finally, right at the peak of all that hype, the insiders dump all their shares for a massive profit, the stock crashes, and everyone else is left holding the bag. Next is insider trading, and it's really important to know there are two different kinds. There's legal insider trading. That's when employees of a company buy or sell its stock, but they have to file public paperwork with the SEC first so everyone can see what they're doing. Then there's illegal insider trading. That's when anyone trades based on significant, important information that the public doesn't know about yet, like, say, knowing a huge merger is about to be announced.
And here's the sobering reality check. While the SEC definitely makes a big show of catching a few high-profile cases now and then, the source material suggests that illegal insider trading is basically an open secret on Wall Street. It probably happens way more often than most people realize, with insiders using that privileged information to get a totally unfair advantage.
So, there you have it. We've explored the market's moods, from that irrational exuberance all the way to outright panic. We've seen how the emotions of the crowd can be an incredibly powerful signal, but only if you know how to read it correctly. And all of that leaves us with one final, and I think pretty crucial question. Now that you know how the herd thinks, are you going to follow it, or are you going to lead yourself?
You see it every single day. Trillions of dollars are flying around the globe, causing stock prices to shoot up or completely tank. But what's really going on behind the scenes? What's pulling the strings? Well, today we're going to pull back the curtain on the powerful forces that move the entire market. I mean, we all see the headlines, right? A stock suddenly surges and makes a fortune for some people, or it just crashes and wipes out portfolios. It can feel so random, almost like pure chaos. But you know what? It's not. There is a logic to the madness, and it all really starts with one simple but incredibly powerful human emotion. And this is it. This is the key. Right at the heart of every single market move, you'll find this one thing. As our source material puts it so well, if there is anything the market hates, it is uncertainty. When the future gets cloudy, I'm talking about war, recessions, political drama, investors get scared. And scared money always runs for the exits. So to really get a handle on this, we're going to break it down into four main parts. First, we'll dive deeper into the market's biggest enemy, uncertainty. Then we'll look at the government's role in all of this, check the economy's vital signs, and finally bring it all back to what really drives everything, people. So let's get right into it. You know, this fear of the unknown can create absolute havoc. When investors genuinely can't predict what's coming around the corner, They don't stick around to find out. No way. They start selling off their stocks and they run for things that feel solid, safe. Assets like cash, gold, maybe even real estate. But uncertainty isn't just about surprise events. Some of the biggest moves in the market are actually driven by huge, powerful institutions. I'm talking about governments and central banks, and literally everyone is watching their every move. Now, here in the United States, the biggest player in the game is, without a doubt, the Federal Reserve. We just call it the Fed. You can think of the Fed as the economy's central command center. And while it does a lot of things, its ultimate weapon is its control over interest rates. That's the cost of borrowing money for pretty much everyone and everything. And this creates a massive chain reaction. It's a huge ripple effect. When the Fed cuts interest rates, it suddenly gets cheaper to borrow money. That sparks a spending boom. People start buying more cars and houses. Businesses start investing and hiring more people. And that economic growth, that's exactly what investors love to see, and it often sends stock prices soaring. This influence is so powerful that there's a famous saying on Wall Street, "Don't fight the Fed." It's really just a simple warning that betting against the direction the Fed is pushing the economy is it's a very risky game. And that's why every single word from the Fed chairman is analyzed down to the last syllable. Okay, another huge factor is the strength of the US dollar itself. And this is a constant balancing act. See, when the dollar is strong, that's great for attracting foreign investors to our stock market. But it makes American products more expensive for the rest of the world. And when the dollar is weak, the exact opposite happens. US companies sell more stuff abroad, but that foreign investment might start to dry up. So the Fed's actions are absolutely huge. But a lot of the time, they're just reacting to the overall health of the economy. This means investors are kind of like doctors, constantly checking the economy's vital signs to see if it's healthy or if it's starting to show signs of getting sick. And the first vital sign is inflation. You can think of it as the silent thief that just makes everything more expensive over time. It's the reason a hamburger that cost 10 cents back in 1959 costs more than $1 today. When inflation gets too hot, your money just buys less and less. And to fight that, the Fed will usually raise interest rates to make borrowing more expensive, which slows down spending and cools off the economy. Now, the opposite of that, and honestly, what's often way more dangerous, is a condition called deflation. This is when prices actually start to fall. And I know cheaper stuff sounds great, right? But believe me, it is an economic nightmare. Why? Well, think about it. If you know that new TV is going to be cheaper next month, you'll just wait to buy it. And if everyone waits, spending grinds to a halt. Companies lose money, they lay off workers, and the entire economy can get stuck in a downward spiral. So here's a quick side-by-side to make it super clear. Inflation is rising prices. The Fed fights that by jacking up interest rates. Deflation is falling prices, which leads to job cuts and a spending freeze. For that, the best thing you can do personally is save cash and get out of debt. Two very, very different economic beasts. Okay, so if inflation and deflation are so important, how do we actually track them? How do investors take the economy's temperature on a regular basis? Well, the government releases a whole calendar of economic reports, and you better believe Wall Street watches them like a hawk. For instance, there's the Consumer Price Index, or CPI. That measures the cost of things you and I buy every day, like gas and food. If that number is too high, it's a big red flag for inflation. Then you have something like the Gross Domestic Product, or GDP, which measures the country's entire economic output. A strong GDP number, ideally over 3%, signals a healthy, growing economy. All right, we've looked at central banks, we've looked at economic reports, but at the end of the day, those are just numbers on a page. The real driver of the market, the force that looks at all that data and decides what to do, is us, people. At its very core, the stock market is just a reflection of human behavior, of our emotions and our psychology. This is really capitalism 101. The price of any stock, when you strip everything else away, is decided by simple supply and demand. If more people want to buy a stock than sell it, the price has to go up. And if more people are trying to sell that stock than buy it, the price is going to go down. It really is that simple. All those other huge factors we've been talking about, they're really just things that influence this one basic human equation. And this slide right here really gets to the heart of it all. In the market, perception is reality. How investors feel about a piece of news can matter so much more than the actual facts of that news. A confident speech from a politician or a really clever ad campaign can create a wave of optimism and spark a buying frenzy, but fear, pessimism, that can trigger a rush for the exits. It's these emotions that are constantly swaying that crucial balance between buyers and sellers.
All right, we've covered the Fed, economic data, human emotion. We've covered a lot. So let's tie this all together. What does this big picture really mean for you in how you think about the market?
So, here are the main things to remember. At its absolute core, the market is driven by the simple human forces of supply and demand. That balance is constantly being pushed and pulled by our collective fear of uncertainty. And to try and manage all that uncertainty, we watch the economy's vital signs, like inflation, and we pay incredibly close attention to what the Fed is doing. Understanding how all these pieces fit together is really the first big step to understanding the market.
And all of this just goes to show why picking a single stock isn't enough. You have to understand the whole environment that stock is living in. So the next time you see a headline about the market soaring or plunging, I want to leave you with a question to think about. Now that you see this bigger picture, what forces will you be paying attention to?
Let's be real. Nobody gets into investing to lose money, right? And yet, so many of us do. It's a really painful lesson, and it's often the same handful of mistakes that just sink people's portfolios. So in this explainer, we're going to dig into the 10 most common traps that investors fall into. The goal here is simple: to help you spot them, avoid them, and ultimately protect your hard-earned money.
So, let me ask you something right off the bat. When you look at your investments, what's the single most obvious sign, that flashing red light, telling you that something is seriously wrong with your strategy?
Well, the answer is kind of brutally simple. You're losing money. Look, making mistakes is part of the game, for sure. But the real failure isn't making the mistake. It's not recognizing you've made one. And as we're about to see, the biggest obstacle you'll face in the market often isn't some complex financial force. It's the person staring back at you in the mirror.
Okay, so here's our game plan. First, we're going to confront the investor's single worst enemy. Then, we'll talk about what is maybe the hardest part of all this, knowing when to sell. After that, we'll dive into the psychology that trips us up, talk about building a personal playbook, cover the absolute essentials of diversification, and finally, figure out how to survive those inevitable market storms.
All right, let's dive right into our first section. We're talking about the single biggest reason why investment accounts get absolutely destroyed. And it all boils down to the psychology of holding on tight when every single sign is telling you to just let go.
And here it is, the big one. Mistake number 1. You don't sell your losing stocks. This is probably the #1 portfolio killer out there. People just hold on, and they hold on, and they watch a small problem turn into a total disaster. But why? Why do we do this?
Well, the crazy thing is, the reasons are almost all in our heads. Selling at a loss means we have to admit we were wrong, and our ego just hates that. So instead, we cling to this hope that it'll come back. We get paralyzed by the fear of selling right at the bottom, just before it turns around. Or we're just plain stubborn, totally overconfident in our original idea.
So what's the fix? You've got to have a plan that takes emotion completely out of the picture. A really simple but powerful one is the 10% rule. If a stock drops 10% from what you paid for it, you sell. That's it. No debate, no second guessing. It stops being about being right or wrong and starts being about disciplined risk management. You're basically turning what could be a fatal wound into a small, manageable cut.
Now let's talk about the flip side of this problem, which, believe it or not, can be just as painful. It's not just about cutting your losers. It's also about knowing when to cash in on your winners before they become losers. And this brings us right to mistake number 2, letting those huge paper profits completely vanish into thin air. You're up big, you feel like a genius, and then you just sit there and watch it all disappear. It's the classic story of what the market gives, the market can take away.
I mean, just look at the story of Ericsson. Imagine you buy the stock back in 1998 at 20 bucks. A year later, it hits $90. You've more than quadrupled your money. You feel amazing. But so many investors just held on, riding it all the way back down. Until by 2002, it was trading for less than $1. The gains, the original investment, poof, all gone.
So how do you keep this from happening to you? Well, here's a disciplined strategy called the 30-30 plan. It's a really mechanical way to take some chips off the table. Once the stock you own goes up by more than 30%, you sell 30% of your shares. It's simple. This locks in some of your profit, but still lets the rest of your investment run. It's a great way to satisfy both that greedy voice and that fearful voice in your head.
It all comes down to this classic trading maxim. Securing your gains is never, ever a bad decision. It's how you make sure that a winning trade actually ends up as real money in your pocket, not just a good story you once told your friends about how much you were up.
Okay, next up, let's explore two really powerful psychological forces that are lurking behind so many of these mistakes: our own emotions and that irresistible pull to just follow the crowd. This brings us to mistake number 3, letting your emotions run the whole show. And let me put it simply, if you can't control your emotions, you probably shouldn't be in the stock market. Overconfidence is a huge trap. You've heard the saying, there are no geniuses in a bull market, right? When everything is going up, it's so easy to feel like you're brilliant. But that feeling leads to greed, and greed leads to really, really terrible decisions.
And one of the most powerful emotions of all is that fear of missing out, FOMO, which leads us directly to mistake number 8, you follow the crowd. Doing what everyone else is doing feels safe, doesn't it? But in investing, it's often a recipe for disaster. Think about it. The greatest investors make their fortunes by being contrarians. They're buying when everyone else is panicking and selling when everyone else is euphoric.
And when this herd mentality goes completely off the rails, you get what we call a market bubble. It's this fever, this mania where prices totally detach from reality. They're driven by this mass delusion that things can only go up. Speculators jump in hoping to make a quick buck, and it just feeds on itself until one day it doesn't.
I mean, the most famous example of this is just wild. We're talking about the Dutch tulip mania way back in the 17th century. People were literally trading their houses for a single exotic tulip bulb, a flower. It seemed rational at the time because you could always find someone else, a bigger fool, willing to pay even more. And then suddenly, you couldn't. The bubble popped, fortunes were completely wiped out, and it became this timeless lesson about the madness of crowds, a lesson we saw all over again during the internet bubble.
So, with all that in mind, how do we actually build all this into a personal strategy? See, success isn't about one single magic rule. It's about creating a personal playbook for yourself that can balance some pretty delicate and sometimes contradictory principles. And this brings us to a huge paradox in investing. On one hand, you need the discipline to create a plan and actually stick to it, even when your emotions are screaming at you to do the opposite. But on the other hand, you need the flexibility to recognize when that plan just isn't working anymore and the market has changed. Being too rigid is honestly just as dangerous as having no plan at all. So this is maybe the most important part of your playbook. You have got to learn from your mistakes. Honestly, you learn so much more from your losing trades than you do from your winning ones. A loss is like tuition you pay to the market. And if you don't take the time to really understand why you lost that money, you are absolutely doomed to make that same error again and again.
Okay, this next section is all about two foundational mistakes that so many people make before they even really get started. It's all about how you build your portfolio and where you get your ideas in the first place.
All right, let's knock out 2 more huge mistakes right here. First, betting the farm on just 1 or 2 stocks. That's not really investing, it's closer to gambling. And second, acting on stock tips you get from other people. I get it, the idea of easy money without doing the work is really strong, but it's one of the fastest ways to lose your shirt.
So what's the solution? Well, it's clear and it's actionable. First, diversify. A good rule of thumb is that no single stock should ever be more than 10% of your entire portfolio. Second, do your own homework. It's amazing. People will spend weeks researching a new TV, but will drop thousands of dollars on a stock tip they overheard at a party. And finally, always verify. Think of a tip as a starting point for your own research, not a command to go out and buy something.
In our final section, we're going to cover the mindset that you need to navigate the absolute toughest market conditions, because it's not about trying to predict the storm, it's about being prepared for it when it inevitably arrives.
And this is mistake number 9, just not being prepared for the inevitable crash or bear market. You should always hope for the best, but you have to prepare for the worst. And that means having a plan that's based on logic, not on fear. When things get chaotic, that plan is your shield. It might mean moving to cash so you can think clearly, or trading less in a hostile market, and using that downturn as a time to study and get ready for the next big opportunity.
Now this quote, it sounds almost silly at first glance, right? But it's so profoundly important. The number one goal for any investor shouldn't be to hit home runs. It should be to preserve your capital. If you can just avoid the big losses, the gains will take care of themselves over time.
And that leads us to our final mistake, paralysis. It's when you let fear completely freeze you at the worst possible moments. The fear of loss stops you from buying when everything is cheap, and the fear of missing out stops you from selling when things get euphoric. It's just a destructive cycle, and it's driven entirely by emotion. Ultimately, this is the single most important takeaway from all of this.
A huge gain that you just give right back to the market, it means nothing. True success in investing is measured by what you keep in your account over the long run. Capital preservation. That's the name of the game.
So, we've walked through the psychology, the strategies, and the common pitfalls. But just knowing this stuff isn't enough. The real goal here is to take action. So as you think about your own investing, ask yourself, which one of these traps, which one will you conquer first? The answer to that question could be the key to your long-term success. Thanks for watching.
Welcome to The Explainer. Today, we are diving into a really raw, brutally honest take on the stock market. We're going to transform it from a bunch of warnings into a clear, actionable playbook that you, the individual investor, can actually use.
Okay, let's just pause on this for a moment. This isn't just some dramatic opening line to grab your attention. The author is deliberately setting the stage here, framing the entire stock market as a battlefield. So, throughout this explainer, our job is to figure out exactly who these sharks are, and, more importantly, what the rules of this battlefield are so you can navigate it without getting bitten.
So here's our game plan for today. We're going to start by really understanding the battlefield itself, why it's not a level playing field. Then we'll bust some of the biggest myths Wall Street loves to tell. After that, we'll get into what really makes stocks go up or down. And finally, the most important part, we'll build your personal survival kit based on some seriously hard-won wisdom.
All right, let's jump right into section 1. We have to start with this core idea, the one thing you really need to get your head around before anything else. The market, well, it is not what it looks like on the surface.
And here is the biggest trick of all. The number one game on Wall Street isn't picking stocks. It's convincing you that the whole thing is fair, that you, the little guy, have the same shot as everyone else. According to the author, this idea of a fair market is the main product they're selling, and it's an illusion designed to get you in the door and keep you playing their game.
Now, what's so powerful here is how specific it gets. This isn't just a feeling of unfairness. The author breaks down the mechanics of how the game is tilted. You've got company insiders who know things way before you do. You have huge institutional players, the so-called whales, who can literally create a rally or a crash all on their own. And that's before we even get to the conflicts of interest and outright manipulation. It's a system with built-in disadvantages for the average person.
Okay, so that brings us to all that common advice you hear, right? The stuff that gets repeated on TV and in articles over and over again. The author makes a pretty bold claim that this advice often helps Wall Street's business model way more than it helps your bank account.
And this is a perfect example of that conflict of interest. Let's talk about buy and hold. It sounds so simple, so wise. But think about it. Wall Street makes money when your money is in the market. So of course they're going to promote a simple, hands-off strategy that keeps you fully invested no matter what. The author's point is that this strategy can be absolutely devastating during a long downturn, a little detail the myth always seems to forget.
And then there's the magical 11% average return. It sounds like a guarantee, doesn't it? But this is such a critical detail. That number isn't based on a fixed group of stocks that just chugged along for 60 years. No way. The indexes are constantly curated. They kick out the companies that fail and bring in the hot new winners. It's like a sports team that only reports the average score of its all-stars. The average is a moving target, not a promise.
Now this one might actually make you a little mad. We're all taught to listen to the experts, to the analysts, but the book describes what it calls an incestuous relationship between research and investment banking. Think about it. If an analyst's firm is making millions in fees from a big company, how likely is that analyst to put out a scathing sell report on that same company? The pressure is enormous, and we have a perfect example of this on the next slide.
I mean, look at this. This quote came from real emails that were uncovered during an investigation. To the public, this analyst was saying, buy, buy, buy. But privately, to his own colleagues, he was calling the stock a piece of, well, you can see what he wrote. This is a shocking black and white example of that gap between public advice and private reality. It perfectly highlights the hidden incentives at play.
Okay, so if we can't always trust the official numbers, if the averages are skewed, and if the experts might have their own agendas, what in the world is the main force that actually drives stock prices up and down, especially day to day?
The author poses this exact question, and the answer isn't some complex financial formula or a secret algorithm. No, it's something way more basic, something every single one of us can understand.
Human emotion. That's it. In the short term, the author argues, it's just that.
It's the collective psychology of millions of investors. Their greed, their hope, their panic, and their fear, that is the single most powerful force in the market.
And this timeline just lays it out perfectly. It shows how these collective emotions swing like a pendulum, creating the cycles we all live through. You know, at the peak of a bull market, greed is so high that even terrible news gets spun as a positive. Then comes denial, when people just stop looking at their 401k statements. Finally, you get to disgust and fear, where nobody wants to touch a stock. And the big insight here? The market only hits rock bottom when everyone has given up all hope, which, ironically, is the point of maximum opportunity.
All right, so now that we've pulled back the curtain on the myths and identified emotion as the real driver, let's get practical. How do we actually survive and thrive in this environment? Let's build our investor survival kit.
Now, before you even think about buying a single share of some hot tech company, the author is adamant you have to build a solid foundation. And just look at the order here. This is crucial. Picking individual stocks is step 3, not step 1. The real priority is getting your own financial house in order, pay down that high-interest debt, and build a diversified base in something like a mutual fund. It's about securing your own life before you step onto the battlefield.
This right here is a massive mindset shift. Most of us are terrified of losing money, but the pros, they analyze, they learn. In this view, a loss isn't just a failure, it's tuition. You just paid to learn a really valuable lesson about the market. It forces you to look in the mirror, check your emotions, and refine your strategy so you don't make the same mistake twice.
You know how investors are always arguing, I'm a value investor, well, I'm a growth investor. Technical analysis is the only way. The author's advice is simple. Be eclectic. Don't pick a side. Use every tool you can get your hands on. Use fundamental analysis to find a healthy company, and then use technical analysis to find a smart time to buy it. Why would you go into a fight with only one weapon?
And this brings us to the final and, I think, the most important section of all. You can have all the tools and knowledge in the world, but none of it matters without this one core principle. At the end of the day, you and you alone are responsible for what happens to your money.
And to really drive this final point home, the author shares something incredibly personal. This isn't some new age investing hack. This is timeless, old-school wisdom passed down from his grandfather, a man who lived and breathed the market his entire life.
Just look at these rules. They could have been written yesterday, but they're decades old. Pay off your debts first. Diversify so one bad bet doesn't wipe you out. Don't buy a stock just because your buddy told you to. It's amazing how these simple, foundational truths echo everything we've been talking about. True wisdom never really gets old.
And that quote just hits you right between the eyes, doesn't it? It sums up the entire playbook. There are no shortcuts. You can't just outsource your financial future to someone else. The government isn't going to bail you out of a bad stock pick, and we've already seen that Wall Street is playing its own game. The buck stops with you.
And that is the ultimate takeaway here. The goal of all this isn't to scare you out of the market, not at all. It's the exact opposite. It's to prepare you, to arm you, to hand you the shark repellent. And the only repellent that actually works is knowledge. So, the final question is really simple. Are you prepared to do your homework?